hit it.
It's Friday, March 24th, 2023, episode 209. I'm Patrick Seresna.
And I'm Kevin Muir. This week we have the pleasure of welcoming Russell Clark to the show. We have a fascinating discussion about his macro process, why Asia is more important than most market participants realize, and why you should never let your kid get into karting. Then it's a two-guest show, and Cem Karsan from Kai Volatility joins us. Cem talks to us about zero DTE options, why they are so popular, and how the volatility market is set up for the coming months. After that, it's time for Patrick's Talking Charts.
And then we do our news segment, which we decided to call VWAP, and we end with the no stupid questions and skin in the game. And folks, stick around. We might even drink some beers along the way.
What are you drinking today, Patrick?
Well, what I'm drinking, because you let your kids raid your beer fridge.
I didn't let them. They're just all of a sudden, folks, I'm trying to find the beers that Patrick and I have planned, and it's just, I can't find them. So
yeah.
This is what happens when you have teenagers and young adults in your household.
Exactly. So I'm drinking the Sky Bison, which is an American pale ale. Let me just read the description. Reach for the sky. Sky Bison is a super crisp, crushable pale ale, dry hopped with citrusy West Coast hops, hoppy and refreshing. It's a great beer for any time.
It actually sounds like a beer that I really like, so I hope my kids enjoyed it.
Oh, God. Actually, it's really nice, actually. All right, but give us some side effects.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include VC volatilizations, Ackman arrhythmias, and this is my favorite, the Balaji barfs. And for those who don't know,
I've suffered for that just a moment. Okay, so let's get to our first interview with Russell.
It's our great pleasure to welcome to the show Russell Clark, who describes himself as a former hedge fund manager who now publishes newsletter while he thinks about what to do next. Russell, thanks for coming on the show.
Thank you for having me.
I've been a fan for a long time, and you kind of joked when we were coming up with the name just a way to describe you. You said the former hedge fund manager who was short for the longest period of time. You were infamous or not infamous, actually famous for being short and still not losing money during the great bull market. Were you not?
Well, I didn't lose money for a long time, but towards the end, I started to lose a bit of money, which is why I sort of stepped down. But it was all built around the way that the world used to work, which is with COVID really changed. And it's one of the reasons I stepped back was like, oh, let's have a think about how the world really works now.
All right. So let's get to know you a little bit better and go through your career. We can tell from your accent that you're Australian. Did you always want to be, a hedge fund manager, or like how did you embark on this career?
Yeah, it was a bit accidental. A lot of the things that sort of happened to me are sort of accidental. So growing up in Australia, in the sort of 70s and 80s, when I was growing up, Japan was a big thing. And if you learned Japanese, that was your way to like having a successful career. So, I went and was a high school exchange student in Japan in 91, and I went back as a university exchange student in 94. And then sort of realized in 94 that Japan was a dead end. It was like everything was going wrong. So, I went back I eventually went back to university, and I ended up in Hong Kong in 98. And in 98 was when like the big hedge funds like the Soros Quantum Fund of the day and other funds were trying to break the Hong Kong dollar.
Okay.
So it's sort of tail end of the Asian financial crisis. And I was working for like this sort of manufacturing company. And it was really interesting. I learned two things from that year of working in Hong Kong. One was China was the next big thing, because I was going into southern China and they had all the infrastructure and the factories were so cheap at making stuff. You knew this was a big story. So I sort of built my career around being as close to China as possible. And the second thing I learned was during this sort of short selling attack on the Hong Kong dollar, they were also short the Hong Kong stock market. My brother was telling me that the bankers working were going to take home bonuses that were like 3 years, a 3 years equivalent salary. right? And I thought to myself, and as someone who grew up in a non-finance family in Canberra in Australia, it was like, wow, that's a lot of money. That's how you really save, right? Because if you can get a big lump sum, you won't spend it. You just go put it in the bank. And so from that point onwards, I was like, okay, I got to be close to China, and then I got to be in finance. So I went back to Australia. I joined UBS, and then after a couple of years, I transferred. I was looking for a job in China. They weren't hiring in 2002 in Hong
Okay.
Kong. So I ended up going to London to work on the EM fund. And I worked on that for about 4 years before being headhunted to set up an EM fund at Horseman. And then I did that. That was pretty good. And then John Horseman stepped down. And so I took over the management of the global fund and just kept going from there. So I sort of ended up being running a hedge fund for, say, 15 years nonstop. And I would have been short more than half the time.
Okay.
That is probably where people really know me from.
That's right. You were famous. Zero Hedge used to talk about you as the guy that was 100% short or whatever your number was and still managed to be up. So obviously you were doing something right. Let's just step back though. Did you go to school did you take a finance degree, an economics degree, or was it something completely different?
So I did. So the ANU where I studied at the time was pioneering this thing called the dual degree. So you could do two different degrees at the same time. I think it's
Right.
quite common these days, but so I did an economics degree and an Asian studies degree, so two separate ones.
All right.
And then when I came to London, I did my CFA, which was sort of like another sort of financial education.
And when you went to UBS, what was that original job? Was it were you a trader, or a salesperson, or back office, or what were you doing there for those 4 years before you got?
I was a graduate trainee, which was amazing. So UBS had an amazing training program for employees. And I think 2000 was sort of the peak of the hiring for banks, and they had these amazing training programs, which involved trips to Switzerland and stuff like that. It was amazing. But I was sort of in the private banking area of UBS in Sydney, but then was able to transfer to the fund management side at GAM after a couple of years. So that was the real attraction of joining UBS, was the training and then the ability to move to more interesting parts of the bank after a couple of years.
What do you, as you know, UBS is in the headlines now. When you think back to your experience at UBS, do you, do you think that this is something that would be expected in terms of Credit Suisse getting, absorbed by UBS, or what was your experience with the culture back then versus now?
Well, I must say, it's actually sort of incredible that they're getting UBS to absorb Credit Suisse, because in the Swiss private banking system, it was very typical for very rich people to have money with UBS and with Credit Suisse. And the idea is they would shift the money between those depending on what they needed and stuff like that. And they really have a dominant position in Switzerland, especially on the retail bank side as well. So, that they're allowing this sort of one monster bank to appear is a little bit unusual. It depends on, of course, if you can. Now, I haven't worked at UBS for a long time. I'm not sure how the Swiss banking market, how penetrated by the banks it's become, but it's still a surprise that they go through. And, to be honest with you, it looks like UBS got a pretty good deal out of this.
Oh, yeah.
They gained
zeroing the AT1 bonds, which certainly helped. And then the government came and, guaranteed a whole bunch of things. I think that the market's kind of voting that the UBS was the real winner out of this transaction.
100%. I mean, and they get the costs out that they can take out are absolutely phenomenal. There's so much overlap. So it's, as long as the markets don't implode, UBS should do very well out of this, but it might take a few years to get the costs out because I think
so you move
traction.
So you move to London, and when you go to London, you become an emerging market specialist. Is that correct?
That's right. Yeah.
And so this all of this was driven by your belief that China was the new kind of frontier where a lot of money was going to be made. And so I take it that you were, who was the fellow, the Irish fellow that kind of came up with the word with BRICS?
Jim O'Neill from Goldman's,
Right,
that
Jim
guy?
O'Neill. So you were kind of at the forefront of the Jim O'Neill, the bricks of that trade, and can kind of tell us what that experience was like, riding that kind of euphoria and excitement at the time.
It was really well. What was weird was that when I started on EM in 2002, you were talking about an asset class that had been absolutely pulverized. So not only did you have the tequila crisis in '94, you then had the Asian financial crisis in '98, you then had the Russian crisis of '99. You then had the dot-com bust, which wasn't really EM, but it did affect places like Korea quite badly. And then you had the Argentinian devaluation of 2001. And then you had like this huge Brazilian devaluation of 2002 when Lula came to power. So back in 2002, you could buy, have you ever heard of the C bond?
No, what's that?
The C bond was, it used to be called Brady's. So
Oh,
the
I know
Treasury,
Brady's. Okay,
yeah,
yep, for sure.
Brady's. So a C bond was like the biggest single dollar Brazilian bond, and that was trading at 25% yield in 2002. And just as China was starting to buy more and more iron ore and more everything, so just as the commodity boom was starting to get going, so you were going into a market that was so neglected. I probably should say, and this is particularly for your listeners or new listeners, I was by far the lowest paid front office person at that firm in London. So I was an EM analyst, and EM was like a dead zone. There was no money there at all. And the only reason I got the job was because UBS was paying for half of my salary costs because it was a graduate trainee program. They expected me to go back to Australia after 2 years. So I only got the job because I was the cheapest guy and the only guy willing to do it. So if you ask, so whenever people sort of say, oh, what should I do? Where should I go? I go find the most sort of out of favor, dejected area in the market, and if you can see there's a good story there, that's the place to go. It's a lot like investing. It's just doing it with your career. It's like if you go where it's hot, it's inevitably near the top, and it's hard to get that sort of traction that you need.
Right. I think that's a story as old as time. I remember in Liar's Poker that Michael Lewis wrote about how Salomon Brothers, what did they do? They closed their money market department right before the 87 crash, and the money market department ended up making the most money at all the other banks once the 87 crash occurred.
Yeah. It's always the way.
It is always the way. All right. So then you go to Horseman. So tell us about that move. What attracted you there, and what was that kind of environment like?
Well, look, I'd been like an analyst on a sort of EM and international funds for 4 years, and I really wanted to manage money, but and then when your headhunter calls up and says, "How would you like to set up an EM hedge fund?" He'd be like, "Oh, it's like a no-brainer to take that." Which is what I did. And I was very fortunate in like the first year, I absolutely, went massively long, very risky sort of EM stuff, made like 100%. And then just at the end of '07, where John and the other fund managers at Horseman were sort of started saying, "Oh, the US banks look really problematic here. I think there could be a real problem." And I was sort of saying to him, if that means like the Fed's going to cut rates and the dollar's going to be even weaker, in my mind, I think like most people at that time were like, that's even better for emerging markets, right? If the Fed's going to come in and cut rates, it's going to be even better. And then one of the older partners at Horseman said, "Nah, Russell, when the US is in trouble, everyone's in trouble." And I went, holy smokes, he's absolutely right. And so I just had this huge year, and then I just cut everything and went in there short in '08. And that was just it was sort of a revelation that everything is sort of connected. And in hindsight, we could see that the credit bubble in the States was a credit bubble everywhere, which was affecting EM debt, everywhere. And so that after the financial crisis, despite people's expectations, emerging markets really never have come back, not in the same way, because everything was the same. Everything was the same trade in many ways.
All right. And so you're there and you spend the next kind of, what is it, 15 years doing that? Is that
Yeah.
like from 15 years? And then over the last couple of years, you mentioned COVID, you've kind of taken a break. And so now you're just relaxing, enjoying yourself, writing a newsletter. Is that correct?
Yeah, yep, that's right. I also, I'm also very busy. My oldest son does go karting, which takes me out of the country a lot these days, and my youngest plays football, which takes me all around London a lot. So I'm sort of like newsletter writer and taxi and funder for my children's aspirations. To be honest with you.
All right, so I was going through your newsletter, and I was actually you're a prolific writer, so you're finding time in between all those driving teenagers around, and so I'd love to kind of talk to you about your views about the market, and I guess let's just start with Japan, because this is something that's near and dear to my heart. And you mentioned that you actually studied Asian studies, and for a while we thought you were going to be going to Japan, and it ended up being you went to China. But let's talk about this. You wrote, but how cheap is this really? And you're talking about Japan, and then you said the Japanese have a saying, and I'm going to butcher this, but hopefully you'll fix me. Genchi Genbutsu, which sort of means go see for yourself. You say I'm a big fan of that approach. Why don't you walk us through what you're thinking in Japan, and you talk about the currency, the JGB market, and the banks especially.
So Japan is really. So when I started working, one of my observations was Europeans and Americans to a degree as well don't really sort of underestimate the influence of Asia on the rest of the world. Was sort of my observation. And you could see that like Japanese financing flows were a big part of how we saw credit booms and busts work. I don't think that's the case anymore, but it was for a long time. So the Japanese were big into Southeast Asia before the Asian financial crisis, other stuff like that. And so, one of my working theories was the capital flows in and out of Japan was why the Japanese, was how booms and busts caused, but also how you got deflation, constantly got deflation in Japan. Because just as they would devalue their currency, they'd send capital overseas. The other country would get too expensive, and they would devalue back, and they would export deflation back to Japan. So that's how I used to think about Japan. But now, in sort of when I look at Japan and think about it more, what I would say is that the Japanese have. So when you study Japan, especially in the 80s, 90s, even 2000s, you get taught that Japan's a super socialist country. So they do everything together. They stay at the same company forever, and there's all these social constraints. So you feel like it's a sort of socialist country in some ways. I'm actually thinking Japan is like ultra capitalist. And what I mean by that is, when the banks in Japan got in trouble in the early 90s, the system then has become to put all of the burden on making the change on the worker. And that's why you haven't seen worker wages rise in Japan for nearly 30 years now. So I used to teach English in Japan. It'd be like about 2,000 yen an hour. It's still 2,000 yen an hour, even though it's like nearly 30 years later. It's absolutely mind-boggling. And I was thinking, why don't you have wages going up in Japan? And what we've seen, particularly in the US, has shown us is that if governments want wages to rise, governments can make wages rise. If government wants inflation, they can create inflation. Central banks can't, right? It's government policy. And so what I've been thinking is, if you look at Japan, it's a big free trading nation, massively integrated into autos. It exports as a percentage of GDP far more than the US. It actually does a much better job than the US, for example. So even though it's got a smaller country, smaller population, it has like 4 main comparative mobile phone operators. I think in the States, you're now down to 3. Is that right? I'm pretty sure.
I don't know. I'm a Canadian, so we're down to like 2. Like we have no competition.
Exactly. So they've sort of stuck to these sort of free market principles, and free markets and capitalism for me are naturally deflationary. And that's why, bond yields are in this huge bull market from 1980s, is because we basically went, we want capitalism, we want free markets, free trade and with freely moving exchange rates. And all of these are very deflationary policies, and the whole world was adopting them. And now when I look at Japan, I see, okay, here is a country that, it knows what's to do. It's just not sure if it's hasn't got the votes to do it, because you've had the same party in power virtually nonstop since the end of World War II. But at some point, I think voters get frustrated and we start seeing change. And that's sort of what we've started to see in the US, starting to see in the UK. I think we're starting to see it in Japan as well.
And
so that's a long answer to your question. Sorry.
Right. But what would be, you've written about the banks, particularly how cheap they are. Do you still feel they're cheap? And do you think that that's a way to express the view of how cheap Japan is?
Yes. So, the Japanese banks have loads and loads of deposits. You have not seen the deposit outflow that you've seen in US banks. And that to me makes a lot of sense, because the Japanese yield curve is still positively sloping. So, the long end yields more than the short end. That's government policy or Bank of Japan policy. So from that perspective, it still looks okay. I do worry because Japanese banks have a habit of having their money in the wrong place at the wrong time when it's a credit problem. But what we're seeing in the States is really a deposit problem. So I think they still look okay. The reason I like Japanese banks is that I actually want to buy Japanese land. Japanese farmland is now cheaper than US farmland, which really shouldn't be the case, because Japan has to import about half its food. So you've got a natural protection for food prices and other things. So Japanese farmland, in my view, should be more expensive than US farmland, just from a sort of supply demand. And they used to be, back in the top of the bubble, Japanese farmland was 5 times the US prices.
Wow.
Yeah, absolutely. Because
there's a limited supply. The currency was really strong.
Have you ever been to Japan, Kevin?
No.
Or?
So actually, I was going to add, that was going to be some of my after hours questions for you, is that we actually have a family trip planned in the spring. So you're going to have to give me all sorts of advice.
Well, I will after the show. But I'll just say one thing that's interesting about Japan is when you get the train, everyone gets a train. No one flies in Japan. So when you get the train from one end to the other end of the country, basically every bit of land is used either for construction or for agriculture, right? And they're often intermixed. It's like there's no really empty parts of Japan. So when you have a property boom in Japan, agricultural prices and residential prices will go up together, if that makes sense. Whereas in the US, you can have the opposite.
And do you think that this is all just a function of the currency being too cheap? Like, if for you mentioned you want to buy Japanese land, and that's great, but it's difficult for a lot of people to do. Is it kind of a surrogate for that trade, just buying the currency? Because on a real effective exchange rate, isn't it just dirt cheap?
Yep, you could do that as well. Yeah, 100%. Yeah, I mean, the currency should appreciate as well if it's a proper bull market. Yeah. So you could do that. The way I look at it is like if you buy a Japanese bank, it's domestic assets, so you get the currency in that anyway. If that makes sense.
Right. One of the things that I noticed was last year, while the YCC was kind of bumping up against creating lots of yen, we saw a situation where the yen kind of forsaked its role as a safe haven currency. Usually in a risk-off move, we got the yen going bid, but it was actually the opposite.
Yeah.
I think that switched back. Do you have any insights into that correlation moving back?
Yeah, I think we've moved. So in the sort of what I would call like the free market pro capital era, that I think ended in 2016, currencies would naturally adjust to their fair value, right? So, and fair value you could judge by trade surplus, trade deficit, that sort of stuff, relative prices, a whole bunch of things. And so that's how because you had deflation in Japan, the yen would naturally appreciate. I now think we're sort of moving away from that. So if you look at US policy of onshoring, for example, you're also seeing the EVs in the States have to have a certain amount of US batteries and other stuff like that. So if you look at like the auto industry, which Japan's dominant in, that industry is now moving to being more protected, not less protected, if that makes sense.
Yep.
And so what I'm seeing is we're moving to, back to the world of like fixed exchange rates or controlled exchange rates. And you don't have this natural correction because I think politicians correctly understand that voters don't particularly like it. The voters want a different system. And so we're sort of going back to a different system, in my view. And it's also being driven by China. China has fixed its exchange rate at where it is roughly now for 5 years with a closed capital account. So the currency regime is, I think, really changing. And it's changing to reflect what voters want, in my view.
Now, one
So
of the
the yen
things
is not going to act like a safe haven as it used to.
Okay. One of the things that I find interesting is that you're saying that there was a change in the financial and geopolitical order, and you're using 2016 as that kind of moment. Why 2016? Because I kind of look at it, and to me, it felt like it was more like 2020. It was the COVID crisis that brought it along, but you're saying it was really 4 years earlier.
So if you go back to 2016, you had three things that happened that year, which basically I think has marked both a sort of political and economic change and a sort of a rejection by voters of the status quo and governments acting on that. So the first thing is like China imposing capital controls. So the way I used to make money, the big way I used to make money was that when I first started at GAM, we used to have like a Wednesday meeting where all these fund managers would come in, they talk about what they're going to do. And the reality is most fund managers aren't that interesting or that different as a rule.
Okay.
No, so you get a guy and if they start talking about tech, they're going to be long tech and you can just look at what the NASDAQ's doing and you'll know roughly what they should be doing, if that makes sense.
Right,
Or,
yeah.
it's just depending on how much risk they're going to take on that trade. And why I say that is like, so let's say the NASDAQ draws down 20% and this guy who loves tech draws down 20%. It's not great, but it's not a career ending move for that guy because the market's down that way. And so people invested with him would have subscribed to that. So that was my observation. What I was fascinated in was what I would call career ending moves in funds. So let's say NASDAQ's down 20 and you drop 50, right? That's a career ending move, game over. And so when I looked at what caused those sort of career-ending moves in funds that turned up, and I'd say about 8 out of 10 times it was because they got currencies wrong, right? And you're talking about yen. Yen is a classic one. It always was with Japanese fund managers. They'd always assume the yen would weaken or stay where it was. That changed with the financial crisis, but there was this sort of general assumption the yen was always weakened. And with emerging markets, India is a classic one. Everyone always loves investing in India, but the currency has a nasty habit of devaluing and putting large losses on foreign investors. Same with all of Latin America as well. Same with Korea. So, the way I looked at it is these fund managers were going through the stock. They're going through the macro. They go into the stocks, and then they would think, okay, currency will just keep doing the same as it's been doing previously. And then, and they probably sort of implicitly were saying, we can run this for a few years and we'll wait to see what happens. And the way I looked at it is, well, if you know the currency is a big career-ending move, just move that to the front of the process, right? And then work your way through the macro and the company specifics, right? So if you need to build a view on currencies and then you can do the rest. And that really worked really great for me from like 2010 onwards because I look at a currency like ruble. I knew it was going to devalue. So I'd find companies with large ruble exposure or Russian companies with large dollar debts and you just short them. And when the ruble eventually did devalue, most of those companies dropped 80 to 90% through no fault. Okay. That was how I used to work. So anyway, when I looked at China from sort of 2013, 14, I thought, wow, their labor costs are getting expensive, land's expensive, property's expensive. They need to devalue like every other country has done whenever they've gotten in trouble in my working experience. That makes sense.
Okay, I'm with you.
And then in 2015, 16, they come to devaluation pressure and they went, you know what, we're not going to devalue. They did a lot of weird things. We're going to close the capital account. which has been done before. But then they spent loads of money on pushing up commodity prices, which it took me a while to understand, but that's what they did. And they just spent massive amounts of fiscal spending, and they got the economy going again. And they've kept the current account, capital account closed. And they don't seem to be. And to be honest with you, I know now China always gets really lots of bad press these days. But if you look at their GDP numbers, they're not bad. Not bad at all. They're doing all right. They also don't have much of an inflation problem at the moment either. Bond market's actually been very well behaved in China as well. So it's just saying that they changed the system, and that was the first big change for me. And then on top of that, probably more obvious to your listeners, is you had Brexit, which basically was everyone but London and a few other areas saying, you know what, we don't like free trade anymore. Essentially, we don't like capitalism, is the way I interpret it. And the EU was a culprit that they could all get behind. So I think for me, Brexit was the wrong answer to the right question. I think people got tired of income inequality. They got tired of wages being suppressed, and so they voted for policies that potentially could change that. And with some success in the wages side, anyway. And then of course you had Trump, who represented, who really reached across traditional Republican voters to new, sort of more union, more pro-worker focused type of voter, particularly in the Midwest. And you've seen with Biden as well that those are now the swing voters. And so, politics has now completely sort of moved to this new world where I think income inequality is not acceptable. Stagnant wages is not acceptable. And this is leading to big macro changes. So I suspect bond yields continue to rise. I don't think currencies move like they used to, because the reason bond yields are rising is because governments are trying to get real wages higher. And when you're trying to get real wages higher, you don't devalue. I don't know if that makes sense to you, but
yeah, no,
yeah.
I completely get it. One of the things that you mentioned earlier was you said if governments want inflation, they can create it, but central banks can't. Although I completely agree with that, I think that the market for the longest time disagreed with both you and I, in that they thought that we couldn't have inflation. I remember people telling me that the 3Ds, which were demographics, the amount of debt, and disinflation from technology, would just overwhelm any ability to create inflation. And then, we had COVID, and we had the long bond went to 70 basis points or something. It was some crazy number, and we really were convinced that we were never going to have inflation. And I think the big surprise of the past couple of years has been that they actually could create inflation. I'd love to hear why you think they can create inflation and what that means kind of going forward.
So, you have to go look at like the history of, the world that we built after the Great Depression. So FDR came in, and he actually, he's the one that before FDR came in, everyone in Europe was terrified the US is going to devalue, because they'd been having these series of competitive devaluations against each other, which had just led to more and more deflation everywhere, right? And so the US came in, they didn't devalue, or not much anyway, not the second time. But then FDR imposed a whole bunch of cartels. And basically the idea was, I'm going to set up a cartel for these companies so they can raise prices, and I'm going to keep competition out. The quid pro quo is they have to raise wages, right? That was the deal. And actually, because of the Great Depression, he was popular on both sides, on the left and on the right. In the end, it was just the left. But at the beginning, everyone got behind it, because it was like, we're tired of this sort of malaise of the Great Depression. And, and you had a lot of debt lying around there, but then within a few years of after World War II, inflation had come along, and you saw massive increases in minimum wage. The minimum wage rose 10 times from 1940 to 1980, right? So it went from like 35 cents to $3.50. What do you think the federal minimum wage has done in the States since 1980?
In real terms, I think it's fallen hugely.
Yeah, it's doubled in nominal terms, right? Over the same period. So the FDR model was minimum wage was, raised massively, and the sort of post-Reagan, or the Reagan model, has been to raise the minimum wage very, very slowly, if at all, right? And if you go and look at emerging markets, so when I first started out in emerging markets, the first you knew an election was coming because they give a 20% pay increase to all the public servants, right? But is that not creating inflation? I mean, in the UK, right? They could, and I think they're going to, but they could go give every NHS worker, every public servant a 20% pay increase, right? And you'd have inflation. But they don't do that. Why don't they do that? And it's got nothing to do with economics. It's all about politics.
Okay. But do you think this has changed?
I think it has changed. Yeah, I do. I think
is that a function of demographics that the old people are retiring and there's more younger voters? Like what's brought about that change?
I think it is a bit. It's the people, the voters who voted against inflation were the ones who suffered through it, particularly in the 70s. So my uncle, who worked in London, he worked for Barclays in London in the 70s, he was telling me he used to get monthly pay increases.
Really?
Yeah. Like, is when you say it the way you go, what, in London? Is that because prices are going up so much. The agreements were you have monthly pay increases. And I was like, that's madness. And he said, yeah, that's why we voted against it. That's why they welcomed Thatcher, who, brought, when she came into power, had a huge rise in unemployment, but was to break the system and break the unions and get union membership down. And so, the policies for, to create inflation are actually already being enacted, more or less. So if you look at the States, for example, I mean, the States is amazing sometimes in what corporates can get away with. But like the non-compete agreements that a lot of tech workers have to sign.
Oh, it's crazy, isn't it?
Yeah. Oh, the non-compete work clauses that McDonald's franchisees used to have to sign. So it was, it was illegal for them to hire other McDonald's employees from the same
I didn't
town.
know that.
Oh yeah, it's the FDA is going after McDonald's, and for good reason. You're talking about the worst paid workers, being forced, not being allowed to be hired by another McDonald's operator, which is all to the benefit of the operator.
Yeah,
naturally, but
Russell, I want to interject here. One thing that I've always laughed about is that all these capitalists will be capitalists when it comes to their side of the equation, but once labor gets scarce and they have to compete for labor, it's funny how quickly they say, "Oh, there's a problem. The system's broken." Like we had a year ago when there was not enough labor, and we were like, "Oh, you can't find anyone who works." I go, "Well, raise the price." You can't have it both ways. You can't love the free markets and then complain when the free markets are working against you.
Well, 100%. I mean, because when I was really wondering about China, I was like, what is China doing? They're doing a lot of policies that didn't make a lot of sense to me. And I was seeing, none of my education was helping me. None of the books I read was helping me. So one day I sat down, I was thinking, what are Chinese economic planners? What book is a Chinese economic planner reading that I haven't read that might help me understand their mindset? And eventually I found that book. Do you know what it is?
No.
The Communist Manifesto. You can buy it.
Explain.
It should be for free, right? But you can buy it at the bookstore if you want. So I went and bought it. I almost said this should be free. Well, how can you charge me for this? I should have gone to the library and borrowed it. I wasn't thinking clearly. Anyway, so I bought it. It's a very, very short read. When they, what they try and do is add all these appendices and stuff to it. But it's like, I think it's like 30 pages, 20 pages. It's just a pamphlet. But I read through it and I had to sort of educate myself on exactly what bourgeoisie means and stuff like that, and proletariat and what the difference was and stuff like that. But they did talk about economics, and this is an idea that for me really explained the difference in the way China manages its economy. So what the sort of Communist Manifesto says is a capitalist looks at labor as a commodity, and it wants to get that commodity cost as low as possible to maximize profits, which is correct. You can't really argue with that logic. And so for the sort of communists, then take the next step is that if you want wages to rise, you need all commodities to rise. If that makes sense. So coming back to the sort of FDR type model where I'm going to let you raise prices, but you also have to raise wages. And so the sort of socialist communist model is naturally quite inflationary because it's looking to raise the price of commodities and keep everything high. It doesn't want that sort of the depression type activity that we had back in the 30s. And you could argue we've been in sort of depression type conditions. Some people say since 2000, some say since 2007. But it's really intriguing how they've got a different mindset and the policies that they've adopted to achieve those. I think what's happening, and this is sort of my big argument, is that the problem is China is so massive and this policy is so effective. It's forcing up food prices globally, and China is now an importer of food. And food prices rising has historically been the harbinger of large political changes, because when poor people can't feed themselves, they get very, very, very angry, and that causes political change. And that's sort of what I'm seeing at the moment. And the political response to that, of course, is to do something, which is why they're raising rates and they're pulling liquidity. And that, for me, it's this what we're seeing in the moment with the bond markets and food prices is this interaction of two very different systems. And the one that's actually adjusting is the West, because we have the more naturally adjustable system, if that makes sense. And so we will be moving more following the Chinese lead until something happens in China, one way or another.
So you think that China is at the forefront of the change that we're experiencing in terms of inflation?
Correct.
Okay, so you're not looking at the change in fiscal policy in the West or anything like that is driving inflation. You think it's China?
I think it's a big change. The Chinese economy is so large. So the one way I think about things, right, is if you look at like the automobile industry and you add in the finance and everything else, it's about 10% of GDP. In some countries, it's bigger. Some countries, it's smaller, but it's about 10% of GDP. And that'll be standard for anywhere, right? So once a country has the biggest auto industry, in a way that becomes the lead economy for the globe. And ever since the auto industry was established back in the early 1900s, the US has been far the dominant car market globally by a long way. Even bigger, still bigger than Europe, even though Europe has a bigger population. China overtook the US about 10 years ago on car sales. If that makes sense.
Yeah.
And when we look at food, which is the market I'm really interested in now, China has been, by definition, China has to be the biggest food producing nation in the world and has been for quite a long time, purely by the fact that it has the most people.
Right.
And I know some people do consume 5,000-6,000 calories a day in the West from time to time, but generally most humans around the world consume roughly similar amounts of calories. And so China's got the biggest market for food. And over the last 5 to 6 years, China, through lack of labor, through lack of land, through wages and other things, has now become a food importer and the biggest food importer in the world. So we've had this big structural change, and which means that the inflationary pressures of the Chinese system are now flooding through the rest of the world. And this is what's causing this change in the rest of the world, because you can't run a capitalist system that is trying to keep wages low while you're having food prices go up, right? If you look at US food CPI, it pretty much matches minimum wage. That makes sense.
Yeah.
They should be, which makes sense to me, right? It's called the bread line for a reason, yeah? So you need to sort of match incomes with food levels. And now what we've seen over the last year or so is that food prices have rallied far faster than wage increases. And that's driving political change, in my view. So governments are going to spend more. They're going to try not to devalue, because that's going to just make things worse. And you're going to get tighter and tighter monetary policy. And you're going to see attempts to try and get real wages back up to levels where people can afford stuff. And so for me, I sort of say to people, I see this as a pro-labor world. We're in a pro-labor world, and it's going to continue until it just becomes unsustainable. And then we have a shift back to like Reagan, Thatcher type pro-capitalism again. But in that environment, commodities do well, bonds do badly, financial assets do badly, and pretty much that's playing out uh, everywhere I look. In China, you've seen property developers going bust because they were beneficiaries of liquidity and capital. Now you're seeing U.S. banks go bust because again they were beneficiaries of liquidity and capital. I expect some private equity guys to go bust. We've seen a few VC guys go bust. I expect some more property companies to go bust in the States as this liquidity gets pulled out of the system. And so that is what I'm seeing. And it's sort of wherever you look, you see it. And I think only changes if China changes.
All right. I've come to the same similar conclusion, but I actually haven't had China at the forefront of my reason for it. And it's actually interesting. I've talked about it as Main Street over Wall Street. And I think that's just a similar theme. One of the things that I was thinking about, though, as you were explaining this, and you were really highlighting that food you think is at the front line of this change. And yes, I understand why rising food would cause bonds to go down. But are you also just saying why not just buy grains outright? Like, will you go and just put that trade on?
So grain itself is very tricky. Storage costs are quite high.
Okay.
And it's almost impossible to store grain for more than a year or two. The Chinese try. So the Chinese by the way, have the largest grain stores in the world by a mile. They have about 50% of all grain inventory globally stored in China.
Right.
And I think that's partly because they know they're at risk from.
It's like an SPR, but in grain and food.
Correct. That's a very good way of putting it. Yeah, 100%. And so they have a lot of grain, and they struggle with it. Whenever they do audits, they'll find that a lot of the grain's inedible. But they try and store it. So storing grain is very tricky. It's also from a financial perspective. People tend to go bankrupt very quickly in the grain market. So if you own like a grain future, let's say for whatever reason suddenly there's huge rains or there's a mega crop that comes along, the price will collapse. And when the price collapses in grain futures, it will just gap down with nothing traded until eventually gets to a price. So there's no way for you actually exit a position in a negative surprise, if that makes sense. Right, so it's really the up and down thing. So my working theory at the moment is you're better off just buying something like gold, which for me is I like thinking of gold as a sort of, if you go right back to the agrarian economy days, if you were a farmer and you had more grain and you'd made a bit of a profit and you wanted to store money so you could then maybe, for the future, you'd probably take your grain and shift it into gold, hold on to it, and then sell gold again when the food was in short supply. I like that sort of analogy that food prices and gold prices should be correlated. That makes sense.
Yep, completely get it. You mentioned gold, and one of the things that has been interesting over the last year is the Ukraine situation and the U.S. and the West imposing, just kind of zeroing reserves that the Russia had in U.S. dollars. And one of my conclusions has been that that's got to mean that if you're China and these other central banks and looking at this, it has to say that I'm going to own at the margin a little less U.S. dollars and a little more gold. Do you buy that theory? And do you think that that's something that's going to be a tailwind at the back of gold for some time to come?
Yeah, I definitely. I mean, that is another great angle to be sort of, the way I'm thinking about things is, I think we're in a political world, which makes analysis very tricky. All right, Credit Suisse is a good example. The politicians decide that the cocoa guys were the ones that are going to get zeroed when equity holders, for example, should have been zeroed first. And
right.
Why didn't they not zero some other bonds, for example? That was a political choice. So when I look at the world now, one thing you could see is maybe, the central bankers of the world wake up and realize that inflation is entrenched and they really need to do something about it, and they just jack up rates massively. And in that environment, I don't think gold is going to do very well. If that makes sense. But I also think bonds will do very, very badly in that world. Or alternatively, the central banks, get a phone call from a desperate regional bank saying, "Guys, you need to invert. You need to get this curve back. Stop this curve from being inverted. Can you just cut rates?" And they might succumb to that. And in that case, I see gold going, through the roof. So what I like to do, and this has always been my style, is sort of look at it. What I've been saying is like long GLD, short TLT as a trade. It fits into this sort of pro-labor inflationary type view I've got. I don't have to worry so much about what central bankers are going to do. What we've seen over particularly last week or so, which has been very encouraging, is that when the bond market has signaled that they're going to be dovish, gold has ramped up. And then when they sort of say, "Oh, we're not going to be so dovish," bonds have sold off, but gold has held up on a relative basis. And I really like that way of doing things. And to me, I think the ultimate end game on that type of trade is what happened in the 70s, was when commodity prices went up so much that gold made you money and short bonds made you money at the same time. And that actually, when that correlation changes, probably means we're getting towards the end game.
Yeah, that's a great way of thinking about it, actually.
Yeah, I like it. It's much more relaxing than trying to guess what central bankers are going to do, because you need, like I said, because we've moved out of the free market system, it's now really a political system. And so the problem with that, and why people hated it so much in the 60s and 70s and 80s, was that it was very corrupt. You had to know what was coming to really be able to make money. And it really benefited insiders over outsiders. And that's why we voted to move to a different system, which I think worked great until around 2000. And then it's become, for me, as someone who remembers 2000, wages were good, property prices weren't too expensive, things were cheap. It was a really good, for me, that was a peak of the sort of capitalist system as far as welfare was concerned. For worker welfare, it was the best of what was. I think that's why gold price was so low back then. Because we were at the sort of peak of getting prices down while keeping wages going up. And then when the dot-com bust sort of happened, we basically had 20 years of stagnant wages while pushing up asset prices, which is great for some people, but really not great for most people.
That's right. All right. One of the things that I like about your writing, Russell, is that you go into the weeds and talk about things that are off the beaten track a little. And I'd love to talk about what you were talking, what's the name of it? The clearinghouses. You mentioned that there was some problems with the clearinghouses, and I'd just love to hear your take on that.
Well, this is the other reason I stopped managing money, because when I looked at the clearinghouses, I found what I thought was like a stone cold short trade of leverage and disaster, and that the clearinghouses were right at the center of it, and no one had picked it up. And so, to me, they looked like fantastic shorts. And what's happened in the end, what's happened in the end is a lot of the problems I had with clearinghouses have come to fruition. The way they price initial margin, variation margin is backward looking, and they're looking to always maximize volume. Right. So to sort of give you listeners a better taste for it, is that clearinghouses prior to Lehman's were sort of like bit players in the financial markets. So when banks wanted to disguise a trade, or not people not knowing what they were doing, they used the clearinghouses as sort of like a hidden trade partner, if that makes sense. So the other person wouldn't know who it was. Now, the reason they didn't use clearinghouses and clearinghouses weren't at the center is they were expensive. You have to post initial margin and variation margin. So pre-Lehman, banks just used to trade with each other, and they often wouldn't put any initial margin. They would just look at the whole set of trades they had, and they go, okay. And if they started to get nervous, they just wouldn't trade with that bank anymore. What that meant in practice was that pricing for risk was done by these huge, very well manned, very well staffed, very experienced risk teams at the big banks, and it would be dominated by the Goldmans and the JP Morgans and the Morgan Stanleys. So the smartest guys in the planet in finance, all looking at each other in a sort of like Cold War, mutually assured destruction type strategy, and like, okay, if that guy gets too levered, I'm in trouble. So they're a very sophisticated risk program. So what happened when Lehman went bust is the regulators went, Oh, Lehman went bust. So those guys obviously didn't know what they're doing, which, to be fair, was probably true. But AIG was the guy that really messed up. But that's another
Okay.
story. But anyway, they went, oh, Lehman's is bust and the banks are bust. But this clearinghouse is fantastic. It suffered no losses because the clearinghouse was using the pricing of the banks and demanding more and more margin in a slow basis. So it had all this huge amount of margin at the clearinghouse, particularly LCH, when Lehman went bust. And so when they unwound all the trades, they found they only used a third of the margin which had been left at the clearinghouse. So the regulators looked at this and went, this is fantastic. Clearinghouses are the bee's knees. Let's stop the banks trading with each other and get everyone to trade through the clearinghouse, and we'll never have a financial crisis again. Okay. That is literally the way they think about it.
Okay.
And I was like, okay, but how do you price the risk then if the banks aren't trading with each other? And that was a question I asked because you had this clearinghouse in Oslo blew up 5-6 years ago, and it just blew up overnight. And so I went and looked at it, and I went, oh, they don't actually have a model for pricing risk. All they do is take the last 10 years of price action and use that, right? And so the better something has been over the last 10 years, the less margin they need.
And not only that, the GFC is now outside that decade.
100% correct, right?
Yeah.
And what that also, and so I went through in details looking at the margin. I mean, I really quite enjoyed researching it, to be honest with you. I thought it was going to be a massive trade that was going to make my reputation go stellar. And so I had it on. But what happened in the end is, and you see the footprints of this clearinghouse debacle in like the gilt blow up that happened this year in the LME nickel market. You were talking about treasuries during COVID. You actually couldn't sell your treasury, because there was the clearinghouses suddenly jacked up margins so much, there was no liquidity in that market. So for me, I look at the clearinghouse and go, this is such a disastrous reform, but they're so committed to it. Now they just do bailouts nonstop. So they bailed out, the LME market was bailed out. Well, they basically canceled the trades. The gilt market required the Bank of England to come in and take the other side. It's a really, really bad trade. But, unfortunately for me, sort of seen as a short seller going, okay, look, stupid company doing stupid stuff, share price should go to zero. What you've seen instead is the governments come in and bailed them out. So the clearinghouses still trade at very, very high multiples, and nothing's really changing. And again, it's a sign of the times that we're in, where governments sort of come in and backstop everybody.
And it's, I guess, saying that price is underpriced. Sorry, risk is underpriced.
If so, what I see going, and another reason I sort of stepped away is that, so the way clearinghouses do things is they create momentum. They're a natural momentum model, because the better something's doing, the less risk you need to put with it. That makes sense, right?
Yep.
Whereas normally, if you're a value type investor, the more expensive something gets, the more risky it gets as a rule. Yeah. But that's not how the clearinghouses take no view on value, not like the old investment banks. So what it does is it creates this momentum model, and then when the momentum breaks, they suddenly go, okay, it's changed now. Now it's really risky, and we mispriced it massively. Everyone needs to give us loads and loads of extra margin, which creates even more downside pressure on the asset.
So they're pro-cyclical, unfortunately.
100%. They know this, so they're trying to change it by adding in pro-cyclical margin requirements into it. It all just seems a bit stupid to me. Why don't they just go back to allowing the people taking the risk to price the risk would be a good system, in my view. And the clearinghouses can't go bust, so they're very disincentivized to do anything about it. And the banks have written long notes complaining about it. But the regulators, like I said, I think are so deep into this really failed reform, massively failed reform, they just can't back away from it. Even though, you would have to be willfully blind to ignore the financial problems that this system is creating. But that is the way we are.
All right. Well, that's some great insights, and it's something not a lot of people are talking about. So I think that highlighting it is, we appreciate it. All right, let's finish up with our 5 questions that we have for all of our guests. Let's start with your favorite investment book.
So it's not exactly an investment book, and it's not even one book. It's a series of books, written by a historian called Eric Hobsbawm. And the reason I think this is such a great series is that he explains how the world we live in today came about through the rise first of capitalism, and then the rise of communism in the 20th century, and then starts to look at and gives you. He died unfortunately a few years ago, but it gives you a sense of how the world that we live in today has come to be, and it really gives you a good sense of of how things can fit together and political winds can change and what that means. And so I tend to recommend people read this book because then they can understand much better the world that we live in and try and understand better where we're going.
What's the name of the book?
So the one they're called The Age of Empire, Age of Capital, and Age of Extremes. Age of Extremes is a 20th century one. And if you only want to read one, that would be the one I'd recommend.
All right. And it's Eric I don't even know how to say it.
Hobsbawm.
That's right. All right. Okay. So next question. Are great traders born or made?
I think it's I'll be honest with you, I think it's a bit of a mix. I think you do need to have a bit of a trading instinct. But then you need to you need to be in the right area at the right time. I think a little bit. And what you tend to see is like good traders can have periods when they do really well and periods when they do really badly, where the markets aren't chiming with the way they think. So I think it's really a mix. And so you just need to I think one of the best trading advice I ever got was that when your ideas are working, bet big, but when they're not working, bet small and wait till the market is more in line with the way you're thinking about things.
That is good advice. Do more of what's working and less of what's not. I think that's Dennis Gartman, and George Soros also talked about things of that nature. All right. Number 3, Don Cox used to say that you shouldn't invest on what's on page 1 today, but what was on page 16 on its way to page 1 tomorrow. Do you have any trades that you would feel would get the Don Cox seal of approval?
Well, I'm really interested in this. So clean energy is a big thing. I know that. And people are talking about that. And they're looking at renewable energies and a whole bunch of stuff. But I'm really fascinated by direct air capture. And direct air capture, it's sort of like a really small part of the renewable thing. And the economics of it are still a little bit unproven. However, what I really like about it is that, so again, I think this is I think about politics first before I even get into any sort of analysis. So I have a look at like the Greta Thunbergs of the world and the sort of young environmental activists now. I think what will they want? What will they want to be doing in 15 years' time when Greta's like Prime Minister of Sweden? And, probably, but I'm just saying it's probably, what I'm saying is, the youngsters now at some point are going to be the guys in charge. Right. And what will they want at that time? And so when we look at, everyone's talking about net zero. And what we're talking about with net zero is to get our emissions down to zero. So we're not putting any more carbon into the system, correct?
Yeah.
Yeah. But what I could see is that in 15 years' time, hopefully when we're at net zero, the political impetus will be on how do we get the carbon that's in the air now out of the air, right?
All right. I'm with you.
So that the only technology I've come across is called direct air capture. And it's done by the biggest player is a company called Occidental, which is Buffett has a big stake in it. And they dominate the market. They have like 75% market share as of today in direct air capture and build by far the biggest plants. Now, in their presentation, they're saying this market is going to be huge and we're only going to have 1% market share of it in 15 years' time. I'm thinking, that is really weird to say you have 75% market share now, but assume you can only get to 1 in 15 years' time. I really sort of think, you know what? It's going to be just like what we're seeing with green energy is at some point, government's going to push the button and say, we need you to build way, way more of these direct air capture facilities. What I really love about that trade is that, let's say in the future, you have Africa and India still industrializing, so still growing their emissions or aren't able to get them under control. You could, as I say, US government could say, okay, hey, Occidental, we need you to build another direct air capture facility in the US to help reduce the emissions in India and China and Africa. And the reason they would do that is you actually need access to underground storage, of which the US is the leading nation of usable underground storage. So I really like that. And it's sort of like a sort of, no one really talks about it because it's not big yet. But I could see it being absolutely massive, huge white space in the future.
Don Cox would indeed be proud of that call. Okay, Byron Ween used to do his top surprises for the next year. He defined a surprise as something the market assigned a less than 1/3 chance of happening, but he thinks it has a greater than 50-50 chance of occurring. Do you have a Byron Ween surprise for us?
Oh, I do, but you're not going to like it. No, not that. It's just going to be. It's so left field.
Oh no, we're going to love it.
Well, I mentioned it last night when I was having some drinks with some friends, and I nearly got shouted out of the pub. So I think we are on the cusp of a baby boom.
Oh yeah.
I think when I look at the data, so part of my theory of why we've had this demographic decline is that when you don't pay workers enough money, then they can't feed themselves. Why are they going to go out and have a bunch of children?
Yeah.
Right. That's sort of like where I came from it. And also I'm thinking, because we've been putting so much emphasis on working and, and correctly and happily we've moved from like this idea of women to stay at home and have children to women in the workforce, which I totally think is great. So what you're seeing is, yes, women are having children later, but what we're seeing now, what I'm seeing is technology is allowing women to have children much, much older, right?
Yep.
And the only issue with that is cost. Now, if governments, just like with the green energy transition, they decide that having babies is a number one issue, they can throw money at that and they can make that happen. And in fact, you've already got a working example in Israel. Israel has a very pro-natal policy where basically cover all the costs for you to have children up to, I think, 2 or 3, maybe even more than that. They have a very, very high fertility rate. Even excluding the sort of more extremely religious parts of the Israeli population, a very high birth rate, higher than anywhere else that you've seen. And so if governments decide to throw money at it, then it will happen. So what I think is interesting is that when I look at China has abandoned its one-child policy. It now officially says, once you have 2 or 3. China is the one country in the world which they could basically go, do you know what? If you want to buy a house, you need to have 3 children. Off you go. And it's done, right? It's like, you go to the missus, right? All right, we're going to have another baby. Okay, done. And they could make that happen. Yeah, it's a bit like saying governments can make inflation happen. If government policy after World War II was a lot about repopulating devastated populations in Europe and elsewhere, and so we had the baby boom. And so if governments want babies, then the babies will come, but they have to put in policies to make them happen. And if you start thinking from that perspective, you can see it is bubbling up all over the place. So I think, I've done more work on it, but I probably talked too much on it. But I've done a lot more work on it, which is fascinating. I think it's really are very close to something really changing there. And again, fits in my view, you want to be short bonds, because if you suddenly get the demographic argument disappears again, bond yields should go much, much higher.
I don't even know if you need the government to do it. I think it might happen naturally. If you go look at the kind of the demographic makeup, there's more millennials than there are baby boomers right now. And they're starting, and as you say, they were previously constrained by not being able to make money. So they were like, I can't start a family. I have no money. Now, all of a sudden, with the labor power shifting, it becomes kind of very easy for them to go out and make families. And I always argue, people say, no, the millennials are different. I go, no, they're no different. Humans are humans. They're going to go do it. They're just a little later.
Oh, look, even more than that is the whole working from home culture makes having kids so much easier. We discovered that during COVID is one of the reasons also it became a no-brainer for me to step away from managing money, not only were the markets not doing what I thought they would do, I need to think about them. I got to spend all this time with my kids, taking them go-karting and doing whatever while working from home. So, all the pieces are lined up. But when I mentioned this yesterday at the pub, oh man, the angry responses I got from people.
That's shocking. You're obviously hanging out with too many deflationists. All right. What advice would you give a young person starting in this business today?
Yeah, it's so I think it's always tricky in that you want to go somewhere when people are really disinterested, and you want to be adventurous a little bit. So if I was looking around, so like I said, I did the China thing because I was like in China. I mean, China was not a fun place in the early '90s. I'll be honest with you, it was a dump. Um, and I first went to China in 1990. But you want to be looking around, looking for places. I think one area that I find fascinating, I think, is like West Africa. I
Okay.
can see the world is changing to its benefit in many ways. Um, if you look at the capitalist system, which we've been in, it really is everyone take care of themselves, and you need to, it's sort of like, we're going to default on your bonds, that sort of stuff. And what we're seeing now is in a sort of this Cold War environment, you're suddenly seeing a lot of embassies turning up in all these different countries because suddenly now there is a political competition for favor. And so what I think is you're going to see, and you're seeing it definitely in Asia, like the Chinese have been investing money everywhere. Now the Japanese are starting to pick up investing money everywhere. I think America and Europe are about to follow as well. So, I can see if you're looking for a boom area, I think markets are going to be very tricky for the next 10 to 15 years, to be honest with you. But if I was thinking about where you could potentially get a boom, West Africa strikes me as a place where it's so important from a population and resource perspective and political perspective. That could be the place that could be really interesting.
And not only that, the Canary Islands are close.
Also, that.
All right, Russell, let's talk a little bit about your son's go-karting because I think it is a fascinating kind of endeavor that not a lot of people do. And I guess that we call it go-karting, but it's a lot more serious than go-karting. It's why don't you explain to people what he does and what it's like and what it's been like being a parent of someone who's doing this?
Well, first of all, I would like to strongly say that no parents should allow their children to do go-karting. It is a disaster from a financial time away, even like just, and you really, go-kart tracks are always in the worst parts of town, often next to like firing ranges or airports or just in the middle of nowhere because they're so noisy.
Right.
And they make other sports parents. So football parents in the UK are famous for being bad, overly emotional. Karting parents make them look like slow coaches. And the reason for that is that in karting, if you spend enough money, you can win. It's a bit like Formula One. If you spend enough money, you can get to the front of the track, no problem. All right. And everyone knows that. So with your very, very dedicated parents, whenever they see their child lose, they can never say because that other kid's better. They always think it's because they've got a better engine, right?
All right.
So you don't get that in football where you have, if one kid's really good, the parents don't go, oh, it's just because he's got good boots on. That's why he beat my son. They tend to be grudging respect. You get none of that in karting. It is cutthroat. That being said, it's a lot of fun. For my son, he's doing really well. In the category he raced last year, he was third in the UK,
Wow.
third in British Champs, which was really a fantastic effort. He was nowhere near that the year before, but he really just stepped up. And there was a lot of thanks to his team at the time, Synergy. And because of that, he is now signed with a European team to race in the European and World Championships. And Europe is really the center of karting. So he's now in the sort of stream to maybe make it in motorsport somehow.
Wow.
We'll see over the next 2 years. It's exciting. I must say, I was talking about karting because when we talk about, like, when I was talking to people about wages going up, so there's a big track in Newcastle, which is sort of in the UK, which is in the sort of Rust Belt up in the north. And whenever we drove up there, we'd have the radio on because I'd be driving them up with the engines and stuff. And you just hear these adverts for like, come be a truck driver for £50,000, which I'd never heard before. And last time we were up there was like, come be a nurse for £30,000. We're desperate for work. And I was like, just saying to people, when I got back to London, I said, look, there's just not enough workers in these places and everyone's desperate to hire people. So that's why I think inflation's coming.
Right.
And so I was talking about, I felt like I had to explain to people reading my newsletter why I was listening to radio in Newcastle. And that's how I got into talking about karting.
It
And
must
that's
be, that the Newcastle portion is probably lost on us North Americans. The fact that it sounds like you're not expected to be there. One of the things I noticed is that the top speed is 130 kilometers. Like,
oh yeah, super fast, and it's all
so
live
it's
streamed on YouTube, so you can watch it as well. So
wow.
yeah, when they crash is bad.
What does his mom think of this?
Oh, she loves it. She's the
Oh,
one
she
driving
does.
the one. Yeah, yeah. She's my wife's was an engineer for Toyota, so she loves cars and she loves the whole thing. So, my son's being very lucky that way. If it was me, I'd just look at the bills and go, "There's no way you're doing this sport." But
You're cut off. Do something that's cheaper, like some football. All right. Russell, it's been a real pleasure having you on. Why don't you tell people that are interested in learning more about you and your newsletter where they can find you?
yeah, it's www.russell. That's RUSSELL hyphen Clark CLARK.com. And I've got it's a Substack, but I've gotten a number of tabs on sort of fertility stuff and also food inflation, and I then write about other general stuff. But please have a follow. I tend to write 2 or 3 times a week, sometimes more if there's interesting stuff going on. Have a read.
Well, it's terrific, and I highly encourage everyone to go check it out. Russell, it was a pleasure meeting you, and thank you very much for your time.
Thank you. I really enjoyed it.
It's our great pleasure to welcome back to the show an old friend, Cem Karsan, from founder and senior managing partner of Kai Volatility. Cem, it's great for you to be on again.
Thanks for having me. Always, it's been a while.
It has been a while, and I've been looking forward to it. The reason I've been looking forward to it is because before this bank blow up, this bank crisis, the topic that was on the height of everyone's lips and what everyone was talking about was these 0 days to expiration options, and there's all sorts of wild things out there that big dealers predicting end of the world scenarios due to these things. And I thought that just sounds a little hyperbolic. And I was thinking that what we really need is an expert. And sure enough, here you are. So, Jim, let's talk a little bit about 0 days to expiration. Why don't you explain to people what they are, who uses them, and then whether you think that the worries about them causing an event, kind of cataclysmic event out there are either founded or overrated?
Yeah, zero days to expiration options are simply, as it states, options that are listed with no time to expiration, with 1 day or less to expiration. They now represent, in the last quarter, 44% of option volume. So dramatic increase in these over the last 6 months to 9 months. And there's been a dramatic reduction at the same time in any implied vol. Normally volume is at about 30 days. Historically, all of that implied vol exposure options trading has reduced by about the same amount. So there's been a dramatic, not just increase in 0 DTE, but a reduction in all the other more traditional hedging options volume.
Oh, I didn't realize that. So you're saying that generally we traded like 1 month options, 1 month and less. That was the bulk of the options. And instead of people trading 1 or 2 or 3 weeks, they've all just gone to 0 days. Not all, but like the trend has been to replace those kind of shorter dated stuff with 0 days to expiration.
Exactly. I mean, it's hard to obviously say if people have just moved or, but the numbers state that there's been a equivalent reduction in the what was previously normally traded to what has increased on the 0 DTE side. So I would assume that some of that is a transfer of types of contracts used, but obviously some new entrants to 0 DTE and maybe just general reduction in players in the other contracts.
All right. So who's using them and for what purposes?
So there's really, as I see it, 2 different types of, you could split into smaller groups, but 2 broad types of traders. One, and this is more for hedges and directional trading, which is closer to at the money, right? So somebody who's looking to express let's say a put hedge, for something, a move, maybe an at the money put or a 1% out of the money put, something close by, or equivalently potentially buying calls and playing directionally on the upside as well. That is in terms of Vega and Gamma, in terms of deltas, those are the bigger kind of trades that are affecting broadly day-to-day trading in the market and are having a day-to-day effect. The second group is really selling of wing units, particularly on the put side. There's some call as well, but primarily massive volume and really, call it 5% plus 6%, even at times, percent out of the money, 1 day options. These are nickels and dimes and 15 centers, right? And, this is that's kind of the classic moral hazard, selling, picking up nickels in front of a bulldozer. But there's a reason that's happening as well and increasing dramatically. One, we haven't had that kind of tail event in a while, so those people eventually get washed out, right? But two, because margining and the way margining works, there's a glitch in kind of the system for a lot of platforms, bigger clearinghouses. Margin and the cost expressing that sale of a nickel or dime is usually measured on a daily interval. So if you do it within 1 day, for many of these entities, it doesn't show up on your margin reports.
Okay.
So there's just a lot more of that going on. And to be clear, 50 to 100,000 kind of S&P daily, sometimes more, right? And that's just what we see in the S&P. There's a lot more in other places as well. That's another issue.
So, Cem, let's just talk a little bit about those people selling the wings, because surely, a sophisticated market maker or large hedge fund knows the risks involved, even if there is no margin, and wouldn't be just kind of nakedly, what is it? What did they used to call it? Just selling the teenies.
Yep.
It wasn't this a famous strategy during the OEX time, and didn't lots of people go bankrupt because it works and it works and it works until one time it doesn't, and then you just blow up?
Yeah, I mean, look, this is a moral hazard. Like I said, entities will do this because they post a 4 or 5 sharp. The reality is, a lot of people who know that they're doing it are happy to do it because they take money off the table as they make their profits, and eventually, as long as they capture enough profits and take it out of the account, by the time it blows up, it's not their money at stake. It's also true that money managers can show really nice track records by doing silly things like this, right? And again, the markets are, people are selfish at the end of the day, and will do things that they're, give them incentives, show me the incentives, and I'll show you what happens here. This isn't a surprise. Now, when you say surely people should know, listen, I think we all know what happened with Archegos, and I can name a million other things where all the big clearinghouses knew what was going on, and they did it anyway for short-term profit.
Oh,
there are entities that will allow this to happen, may very well know that it's happening, as long as they have kind of certain restrictions. Or maybe they have to be further than 7.5% out of the day, and they have the ability to call the capital on it at intraday or whatever. And some are just, there's a lot of, believe it or not, really kind of naive clearinghouses or entities that just, again, at the end of the day, the OCC, the entity, right, that is and the exchange, the Merck or whatever exchange are responsible for posting clearing requirements behind the clearinghouses, and those entities don't look at that stuff daily for the most part. So there's flaws in the system essentially that are allowing these things to happen, and they continue to be there.
Do you think that it'll take
yes, always.
Oh, really? Okay, so you don't think anyone's going to get out ahead of this?
Nothing gets solved without a crisis, ever.
All right, and so let's go back then to my original question when I said there was that a famous sell side research report about how this could cause a cascading event. Given the fact that you believe that these are kind of being sold by entities that let's just say that they would have to delta hedge or cover them if they went down there. Do you think that this poses a risk, has increased the chance of a dramatic one-day sell-off?
Now, to be clear, we have two different pieces going on, right? You have zero, kind of the zero DTE kind of at the money or near at the money kind of plays, right?
Yep.
And then you have these tails. There's no doubt that the tail exposure introduces, and the increase there increases the probabilities of some, if we were to get a 6% intraday move, which is pretty hard to get, right? If we were to get that, my guess is that it would turn into an 11% move, right? That's the kind of realities of the amount of, in an illiquid environment, the introduction or having to cover of these types of contracts, that would drive that type of exposure. So that piece definitely has that component, but you can go a long time without a 6% move, right?
Right.
And there very well could be, contrary effects of some of the other trades that are pushing that the other way.
Now,
there's been a lot of conflicting. Again, it was obviously you referred to Kolonovich and J.P. Morgan. I think Bank of America came out with a very opposite read on the scenario. My read is that yes, those tail units specifically, which by the way isn't something wasn't happening at all before. It's just increased in volume.
right.
Definitely present a bit of a tail. But I would say that's probably not the biggest issue. I think there are bigger issues that are opening up a bigger potential tail in option land, and that is that other fact that there are just less people hedging real vol. It hasn't worked. All that hedging that happened at 30 days and all that vol exposure that the street had as hedges got absolutely decimated in the last year, right? Because people did hedge.
Right.
We're concerned about a decline. And we've talked about this at length. That led to a very market down, vol down regime, very low realized volatility downside move. And what you've seen is a year of pain in that kind of long vol world, which has really pushed people out of those products. Because again, at the end of the day, the mentality is, well, I've held these things for years. They haven't worked. Now's the exact time that they should have worked. And, they didn't do anything for me.
Right. Why do you explain to people why they didn't work and what they were how the hedge that they had hoped would protect them ended up in essence, the decline was not fast enough and it didn't do the job that they want. Explain to people why and how that played out over the last year.
Yeah, to be clear, everybody thinks that realized vol is the driver, right? That's the thing that ultimately forces whether the implied vol works or not. The same is true the opposite way around. If implied vol or hedges are the market's very well hedged, that means there will be a lot of selling of vol into a decline. And that itself forces a lack of a move in realized vol. And we saw that in 2017 at its greatest point, right? That's the theoretical example that everybody points to. That was the lowest realized vol by 30% of any year in 125 years of history. That was a function of massive implied vol supply.
Okay.
This last year was is a perfect example of the same thing. That the market was very well hedged. Skew was at record levels in the S&P 500 across indexes. There was broadly, after a big rally, a lot of expectations that a decline was coming. And instead of just selling stock, people were buying vol because that was what worked so incredibly well in March 2020 and fresh on people's minds. When people are hedged or have certain positioning on, not surprisingly, it doesn't tend to work. And the reason it doesn't work is because as you go down, people have to sell those puts to monetize. The more it doesn't work and the more the hedges to their stock begin to lose money, there becomes a stampede out of vol. Not just a selling to monetize. And that's what we got. We got a flattening of skew and implied vol, massive underperformance of skew and options writ large in the last year. And that has been the most kind of hallmark kind of thing of this, unique thing about this recent decline. The reflexive effects of that are people abandon those hedges.
Yeah.
That people no longer say, okay, this is, I'm not going to, I stuck with this for a year into a decline when it was supposed to work and it didn't work. So I'm going to go somewhere else. And my read is that a lot of people have gone to realized vol. The reality is realized vol was quite high. You had decent moves intraday, but the implied vol response was always met with implied vol selling, and broadly implied vol itself did not work, and particularly skew and the implied volatility skew did not work. So that has led to a natural chasing of what's working, and that's how it always works. People have chased it and moved out of real implied volatility to much things that have been working, whether that's directly moving from that to the other, or just people who are using the realized vol, with zero DTE options, making more money, so getting more assets, versus the other ones losing money, right? It's the same process. And ultimately what it is people have moved to gamma, like the short dated options that are much more focused on the realized vol move and aren't really dependent on what implied volatility actually does in response, versus being in implied volatility hedges. Now, to most people, these are the same thing. They don't understand the difference, but they can cause very different market reactions when you look under the hood. Implied vol and realized vol are assumed to move in lockstep. They do not move in lockstep. There's a clear connection at expiration between the two, but there's a significant difference under different regimes of what performs in different environments. Just like implied vol hasn't performed recently, and realized vol has, we see periods, and that hasn't happened for quite some time, really. But I think 2018, February, right? The vol-apocalypse or Volmageddon would be an example of where you had a dramatic implied vol response with a relatively muted realized vol response. Long-term capital management would be another. The market had a decent decline, but the vol reaction from under hedging or a lack of or too much selling led to a dramatic implied volatility move. Those are just two examples that are more short-lived. 2008, once vol went higher, yes, we had some realized vol moves, but those were nothing compared to how high vega and implied volatility went during that period as a function of an imbalance of supply and demand of implied volatility. So my read, and almost always this is how things work, when supply and demand get out of balance in any market, but particularly here in the vol space, you better look for wherever that imbalance is to reverse. And the people who are, long what's been working to start losing money, and the people who are not long what they should be or short to start, getting hurt as well. This is often what drives this very cyclical, I refer to it as a second move phenomenon, but this very cyclical move over the last 10, 20 years of vol underperforming into declines, followed by a year and a half, 2 years later, a massive outperformance of vol. It's a mean reversion to positioning, and positioning is really what drives the majority of this performance.
One of the things that you mentioned in there is you said that people moved from implied vol and skew to realized vol. And you use the example of zero DTEs, but is that also variance swaps? So like how does one, like people that are transacting in this space, actually do that change?
Yeah, I mean, there's many ways to do that, and I'm not going to walk through every single
Just give us a kind
permutation.
of a flavor of
Yeah.
what they might be doing.
Yeah, but zero, the shorter the duration of an option, imagine I buy a zero DTE put. If I buy an at the money put and the market drops 4% or something, right? I make 4%, minus whatever premium I paid. It's a break even story, right? That's the power of gamma, right? That by the time that move is done, that put is now 4% out of the money, or in the money, I guess I would say, right? And there's no implied volatility left to that option. There's no time left to it. It just expires.
Right.
That's gamma at its core. That's realized volatility, and there's very little complexity to that. The reality, though, of a 30-day option is more complicated. It's not just a function of the realized move that happened that day and the amount of gamma in that move. It's a function of, okay, now where are we pricing going forward?
Right.
Implied the volatility going forward and the skew and the amount of implied volatility of the option that we're talking about. And that can change dramatically. You could have a situation where a 10% out of the money option, with a month to go is priced on 25 volatility and into a 5% decline, that option may go to a 40 volatility, right? You may have a situation too where you get a 5% decline, and all of a sudden that is not only just staying at 25, but maybe it goes to 20, right? That leads to dramatically different outcomes. The problem is if people aren't hedged at 30 days or 60 days or 90 days or a year or whatever it is, right? Or worse, they're selling that implied volatility to buy the gamma in the short data, which is also happening, by the way. The net effect is if implied volatility continues to go higher, and yet the realized move doesn't, I said we get 1% reduction in the market or 0.5% or, something small or continued mean reversion of the one-day options, but implied volatility begins to march higher. Hedges become more and more expensive, and they're losing money on the gamma move. That does happen over periods. You can get dramatic increases implied vol without realized vol increases. And it can make hedges more and more expensive and make it harder for entities to hedge going forward. And worse yet, if they are actually short Vega, which there's a lot of short Vega out there to fund the gamma. That's been the trade that has worked incredibly well in the last year is selling long dated Vega to buy gamma. It's honestly been a theoretical trade, going all the way back to long-term capital management. These are theoretical trades that should work in theory based on theory, but supply and demand often, has a bone to pick with theory, right? Yeah. And so I suspect that's where we're heading.
All right. One of the things that you've talked about is the positioning and how the market is set up. I'd love to talk to for you to kind of shed us your insights on how you figure out where the market is in terms of it's well protected, it's not well protected, and also the problems with just kind of blindly looking at the open interest on the puts or the calls. And like I remember last month, or maybe it was 2 months ago, there was a lot of talk about the 4,000 S&P puts that had a big line, but when I went and found I found a 5,000 that was almost the exact same size, and it looked to me like it was a box trade, and it kind of it makes it difficult to just kind of look at those absolute numbers and make deductions about it. How do you deal with that? And how do you figure out where the market actually sits?
Yeah. So, assumptions, I forget what the quote is, like make an ass of you and me, right?
Yeah.
Like you have, that's the devil's always in the details. I think there's a lot of entities out there that would like to sell you that they have some, that it's easy to track positioning and understand the effects of it. It started with kind of gamma effects, so without even looking at any of the other kind of delta effects of options, kind of in a vacuum, and that was the holy grail for a year. And surprise, surprise, it's not as easy as it seems, right? The reality is different entities who warehouse positions have different reaction functions. It starts with customer versus dealer, and that's kind of the one that people have now begun to capture and think about. And the assumption has been, if we could even determine what different trades are housed and what they mean in terms of gamma exposure, the general assumption is that dealers hedge their gamma exposure and other Vana, Charm, the other things I talk about exposure, and that customers don't. But that's not necessarily true either, right? There's a different kinds of customers and different kinds of dealers. A market maker is not a bank, is not a fund who is also warehousing said risk. So understanding the trades that are being put on, who they're warehoused with, and what their reaction functions are is the key. And that is considerably more difficult, right, than just looking at open interest and
Right.
determining, okay, this was traded near the offer, this was traded near the bid, so it must be a tipping point. Now, much like a lot of things, you can get 60% of where you need to go with very basic tools, or maybe even 70%. But the problem is if you start assuming things based on what that 70% that you think for all scenarios, you end up getting a real tail on the other 30%.
Right.
And so I'll leave it at that. But no.
So do you actually So can I ask, do you actually try to figure out who's on the other side of most big trades? Like, are you, or if you're not comfortable talking about that, that's fine. Tell me
No,
to
I mean,
buzz
I
off.
can give you generalities, but the answer is yes. We are tracking dealer positioning,
Right.
and that means that doesn't mean we know everything about everything, but that does mean we know a lot. We were 13% of the S&P 500 option flow during the great financial crisis. We were market makers for 15 years, and one of the biggest. So we put a lot of kids through college and paid for a lot of second homes and have a lot of relationships that allow us to see more clearly what the volume is and what's actually happening in real time. We also have run kind of institutional money and have a lot of internal flow on structured products across clearinghouses. All of those things are important, but just as important as the information that we gather is the expertise that allows us to understand the reaction functions of the different parties at
Okay. So
play.
it's not just figuring out what party's got what trade, it's also figuring out how those different parties are going to react as they have to delta hedge or they're faced with different market events.
Correct.
All right. Now let's talk. We've been talking about the dealers and the market makers doing trades. I think for a lot of people, they probably don't understand how institutional size trades go up. And one of the ones that, has gathered a lot of attention is the JP Morgan whale. Everyone knows it's at the end of every quarter. It's this big, huge buying a put spread in the S&P 500, and it's funded by selling the call. Could you just walk us through? And actually, I shouldn't have mentioned that one. Let's not use any specific example. Let's just say that a big client wants to do a large trade, and it's too big for one broker to do it alone. How does the process work in terms of how it's set up, how it's negotiated, the feedback? I know a lot of times you'll see when there's a trade that's very, very large, it'll be divided up. Sometimes it'll be half of it'll go in one big chunk, and then there'll be a whole bunch of kind of 2,000s and 3,000 lots. And I'm assuming those are different little market makers on the other side that all want to be involved in the trade. I just love some color about how that works.
Yeah. So you're going to try and get me in trouble here, Kevin.
Yeah, no.
Talk about specific trades.
We're definitely not talking about the JP
We'll get
Morgan
some
trial,
calls
but
from
it actually
JP
doesn't
Morgan.
even really matter because they're all the same. Like it's just that we're talking about in general the institutional size trades, how they work.
Yeah, from 30,000 feet, what happens? So you have a world where dealers, market makers, entities that are that survive not just on a bid-ask spread, but any ounce of information is financially profitable for them as an edge. Trying to, much like ourselves and others, trying to find the unique fingerprint of every type of trade, right? And for the most part, there is a unique fingerprint to most trades. It is very hard to hide, if you're a regular player, right, your kind of signature.
Right.
That is something that, again, most sophisticated players are aware of and are trying to, at the same time, battle against, right? They don't want to give up that information. So there's a constant struggle, right, between two sides, one trying to hide information and one trying to collect. Not surprisingly, there are a lot of big customers who cannot hide. They have certain rules that affect what they can and can't do, right? That helped. That JP Morgan trade would be an example, right? It's out there in plain daylight when they have to execute and what they have to do. The AUM of the fund is well known, et cetera, et cetera. So everybody knows that trade when it goes up. It's not a surprise, right? Even that said, like, they don't put it up at one broker. It doesn't happen in one place. They try and distribute it. They try and do it over time. They try and, do their fiduciary duty to the best of their ability. They're just, it's almost, they're faced with an impossible task, right?
Right.
And that's true for the majority of big trades because they're just too big to hide, right?
Yeah.
And again, there's more to these things than just the quantity and the price. It's the type of structure, right? How the spread is put together. It is, it is the timing. It is the brokers that is used. There's so many, as you might imagine, kind of pieces to a trade. How it's routed, right? There's just so many little details that you could track. So how does that actually happen? they may go to their bank who's their prime, right, and ask the prime to take down. The prime might give them a price to give, to execute the whole order, and then the prime might work out of it, right? That's one way to kind of hide it over time and get things done. For bigger trades, it's just too big for one prime to take it all down, so they won't do that. They may distribute it across different brokers themselves and trying to execute. They may execute exclusively digitally. They may execute in a block on exchange, depending on the trade. There's a million different permutations, but for the most part, it is this push and pull of trying to hide it. But again, at some size, and the bigger trades are the ones that matter, right? It's almost impossible to hide.
Right. But and not only that, when you're sitting there as a large institution that's trying to, let's just say they're trying to buy an option, they have, not only do they have the Vega that they're trying to buy, but then there's also the inherent delta. And thought it'd be helpful for people to understand that sometimes they come and they just lift offerings on puts. So let's just say that there's a big buyer, you'll come in and just lift it on offerings on puts. But other times it'll trade against a delta, so that ends up being that the market makers on the other side only have to worry about the Vega part of the equation. They don't need to worry about putting in their hedge. Could you just explain to people what I mean there and how that works?
Yeah, absolutely. So the other thing, other than just hiding kind of the trade and the signature of the trade, the other thing, in order to get best execution, you want to do is really limit the market impact, right? And the way you limit kind of the first order impacts is to reduce the delta of the trade and try and take it to zero. By doing certain things, you can do that. So there's a concept of tying up a trade. So if you're trading options, every option has a delta that's relatively well agreed upon, and those deltas can be offset with underlying futures or underlying combos, which are synthetic futures, or just tying it to a in the money call or in the money put, depending on what the hedge that needs to be placed on it are. In the case of that JP Morgan trade, those are almost always traded delta neutral, and they're generally done with an in the money call that has a zero, essentially a synthetic future that has almost zero premium left in the put, maybe a nickel, maybe a dime, but they're using that in the money call to offset the delta of the trade. So it doesn't have a direct market impact at the time of trade. Now, that does create, because they offset the deltas in a different expiration in the case of that trade, that does create some roll effects. So entities have to roll the deltas, the future kind of exposure from the expiring day of expiration out. But again, everybody knows this is coming. The entity wants, JP Morgan wants the crowd to know it's coming, so there's not a big market impact. And so people, market makers, banks who are going to take the other side of this proactively roll those deltas, and these are liquid markets anyway. So instead of buying and selling deltas at the market, they're simply doing future spread equivalents or rolls, jelly rolls, and rolling out those deltas, which is a much less market impactful trade. And again, because this is a well-known thing, it's there's a broad preparation for that happens ahead of time. So a lot of these assumptions of, they must be selling, $20 billion of delta at the market it's nonsense, right? People are out there telling you that they don't understand the dynamics of how these trades work. There was a $20 billion of roll that had to be rolled over that time, which is a future spread, but that gets worked out very incrementally over time. And the grand scheme of things is a very small amount. It's not like hitting the market with $20 billion of stock.
Right. And then sometimes, like you had been tweeting about a certain uncle that likes to come in the market and buy S&P 500 puts. Would those traditionally just be like he phone up and say, offer me 1,000 of these up above, and he just takes the offering and does it as a block trade?
Yeah, at the end of the day, if an entity is coming in and just trying to take delta exposure along with their vol exposure, right? If it's a true hedge that's coming into the market, they're not going to tie it to a delta because they need those short deltas, right?
And
It's
those
also
it just comes down to the pit, and all of a sudden there's a big print that's put up above, and they just clean out all the offerings.
Yeah, again, it depends on the customer and how they
Yeah.
operate, right? There are certain customers that are hedging that would rather go to their prime and have their prime take the delta all at once and then work out of it, so they're not hitting the market. In the case of that one entity you're mentioning, who we believe to be someone in particular, is that is a very has a very clear signature on purpose. Maybe maybe he wants the
Really?
crowd to know, because
Yeah.
much like being an activist, which he is, there is a benefit to people knowing that you're taking a side, right? If you're investing in a company because you believe it has upside and you let the world know, and you're a well-known entity that tends to do quite well, people are going to come in and support the stock. It's not too different here with a hedge trade. So, part of me thinks that that's a kind of an effect that he doesn't mind, right?
Well, that,
But yeah, there are definitely entities that would rather just hit the market and take it. But that said, that has direct delta when it affects the market. You can see it once the order hits the market. People knows what it is. Market sells off even before the order gets filled. Right? It's not just the hedging of the order. It's the simple fact that people know that it's out there and that this entity is trying to essentially sell these deltas right to the market, and they will proactively sell so that once they sell the puts on the other side, that they get better hedges. But yeah, that's probably the way it works. Is it's not just, oh, this is coming to the market, so people are trading it and selling deltas. Information is what ultimately leads to edge in a lot of these cases. And the sooner you know that entity is coming, the sooner you're selling deltas, and the market's already reacting generally by the time it hits the market, because things can't hit the market instantaneously. Often there's information leakage along the way.
all right, folks. Unfortunately, we had a little bit of an internet problem and we couldn't finish the interview with Cem. So I'm going to do his wrap up. First of all, if you want to go, check him out on the Twitter. He's got a great content there. You can reach him at jam_croissant. I'm going to spell that because I'm also saying it with my Canadian accent. So it's JAM_CROISSANT. The other thing you should do is you should go and check out his website, Kai Volatility, KAI volatility.com. They've got all sorts of great new content. They have increased the gems. He's sending out newsletters with his media appearances and all sorts of other research and stuff. Make sure you go check it out. Thanks a lot, Cem. All right, Patrick, it's time for Talking Charts. Lots going on, lots to talk about. What's on your plate first?
Okay. Let's start off with just reviewing the top 3 things we were watching several weeks ago. Number 3 was the U.S. dollar. And we were looking whether that U.S. dollar index was going to continue to mean revert. But really, especially in this post-FOMC, the dollar has started to break back down toward its year lows, and just doesn't seem to have any momentum at all here. Anything that you want to give insights to there?
Well, I've been highlighting and watching the yen. I think it's behaving much more like a risk-off currency, and I think that that's changed the nature of the U.S. dollar index, because there'll be times now when we get a situation where the euro will sell off, but yen will be bid. So
yeah, that was definitely.
It's not quite as uniform as just dollar is going all the currency going one way.
Yeah, the key breakdown in the dollar index here that happened over the last couple of days was really that escalation of the situation in European banks. But we'll talk about that in a moment. So number 2, did the banking crisis start a new sell cycle? And right now the answer is definitively no. But we'll talk more about the charts, because there simply hasn't been any legitimate breakdown to lower lows unless you're looking at the Russell. But that's something I want to talk about in a moment. But number 1, we were talking about that inflation numbers, the CPI, PPI, and retail sales. And everything somewhat in line or weaker at this point. Is there any observation you'd make?
Well, I did find it today, actually, today's and the ISM, I think it was the ISM, where the services came in way hotter. And so this really is a tale of services just refusing to give up. And in fact, it ticked up. And I think that's the real problem that Powell is facing.
Right. All right, so let's talk about the top 3 things to watch over the next couple of weeks. And so coming in the next 2 weeks, at the start of April, will be the jobs numbers. And clearly, a lot of people are watching whether or not we start to see the kind of economic weakness start to, and at some point, reflect in jobs. And there really has been no sign of that until now. Do you think this is one of those job numbers that continues to just show resiliency, or you think we finally see an uptick in unemployment?
Well, any one number, anything can happen, Patrick, but there's been very little sign that the jobs market is loosening up. And not only that, even if we did get a slight uptick in jobs, it doesn't really fix Powell's issue. Powell's issue is that he has inflation. So although, yes, it's something to watch, and yes, it's something the market will focus on, I'm not sure it is the most important thing in terms of the Fed's policy driver.
Right. So number 2, I wanted to talk about this Russell NASDAQ and the divergence between the two. So let me just pull up the chart. I'm going to start off by actually just looking at the actual Russell over the NASDAQ. And when you look at this ratio, you can clearly see there was an outright collapse of small caps relative to the NASDAQ, which has been outperforming and continues to actually be up throughout this entire period where the financial distress has been. But obviously, I would contribute a lot of this to the fact that Russell has many of these regional banks in the index. But overall, is the Russell breakdown and generally those smaller cap names breaking down something that we should be paying more attention to, or you think it's just simply the regionals dragging it down?
I think it was the regionals dragging it down. Are we going to talk about that, or are we going to get through the? You want to talk about it now?
Well, no. Well, as long as we're talking Russell NASDAQ, we should talk about it now. Yeah.
I think that the Russell NASDAQ will go completely with the banking crisis. I think that chart corresponds. Like if you look at when it started, pull up SIVB. I suspect that the first day of SIVB was the first big down red candle there on the Russell NASDAQ index. What was it, March 9th? If I got it right?
Yeah.
So if we go look
well,
go back
you know
to
what?
the
If we're going to actually look at the regionals, then we should just quickly announce what number 1, which was the big banks, little banks, Euro banks, failed banks. Little Dr. Seuss here for you, buddy. But we obviously wanted to talk about these banks, right?
Yeah, and so let's first of all get something out of the way. You were giving me a hard time about the KRE, and you said there was a lot more pain to come, and you were absolutely correct, Patrick. I was wrong. You were right.
You know what? It's so easy to actually trade against you because you're early to everything. So the thing is, it's not that you're going to be wrong.
Well, no,
eventually you're going to be right. You're going to be right. There isn't going to be Armageddon. The regionals will settle this out, and there's going to be an opportunity to profit. But the thing is that like every other macro call you make, you're way early. So the easiest thing to do is whatever you're doing for at least a week or two, do the opposite of you, and then join the Kevin Muir camp. That's the easy way. It's like a sure win.
Well, maybe you're right, but I have to give you credit. You said it would spread, and it definitely did spread. I was shocked. I still think
I didn't say it was going to spread. I said it was too early because usually, at least from as a market observer and a trader, I notice that when one of these types of things happens, it takes at minimum usually a week to work through the system, but often can take a month or more for one of these kind of cycles to fully play out. And I mean, you were buying the first downtick.
Like, no, it wasn't the first. No, it wasn't the first, but it was too early. No doubt about it.
It was too early. Yeah.
It was too early. I guess for me, what I'm amazed at has been the violence of people to jump on what I think is an isolated issue, mostly, and in a few different banks, and then spread it across the entire banking sector. And one of the things that I find would just flabbergasting, Patrick, is the fact that people are saying they don't have the money to pay. You know, if everyone asks for their money, there's not enough in the bank. Well, no shit. Nobody does. Like JP Morgan, if everybody asks for their money tomorrow, there's not enough money in it. That's how banks work. And yet this is getting passed around, Patrick, as some sort of terrible system. And it's just I've seen on Twitter the stuff that gets passed around and the fear that gets perpetuated throughout the system. And I guess I just misjudged that. I didn't think people would be so keen to bring down the system.
You know, I'm going to try to avoid trying to be doomsdayish about this, but the way that I would but the way I look at it is financial institutions are in the credit markets incredibly highly leveraged machines, right? And just like you were saying, that if everyone tried to draw their money, you're going to draw their capital down and all these things that create crisis. But then if you recognize that there's these highly leveraged machines, they're vulnerable to the same things that create liquidity events from margin calls. The fact is that all you need is a sentiment shift. When everyone is highly leveraged in the margin market, now they try to sell, it creates a liquidity event that wipes things to the downside. Why wouldn't the same thing apply from a sentiment perspective when people get worried about the banks and make a bank run? This is where I think when you said it was an isolated event, I think that's where you were wrong, because ultimately the leverage in the system is so great.
But Patrick,
that these things can feed on themselves.
So the leverage is way less than it had been in most other or over the last 20 years.
Periods. But a bank run is still a bank run.
And not only that, the banks, in terms of their actual loan books, have never been better. There was actually very little. It's amazing.
Well, as long as you're a top 4 bank.
But it's amazing that the thing that everyone was encouraging the banks to buy and thought, oh, you know what, this is the safest asset, is the thing that everyone's most worried about. It wasn't risk. It wasn't their regular business that is driving a lot of these companies, these banks, into trouble. It's the idea that they lost too much money doing quote unquote safe things. So I think that there's so many parts of this that are just funny. But Patrick, you're right. The banks rely on confidence, and they lost confidence. And I guess what I'm saying, though, is that what's interesting is the fact that we're in this social media, highly connected world, that these things can happen way faster than I ever imagined.
Right.
And that's the part that's the part when I'm looking at my mistake, and make no mistake, I'm not saying, oh, everyone else is idiot. The market went down, so I was wrong. And there's no doubt about it.
Lucky you put all the trades on the long gamma, and you didn't do something crazy like actually buy the equities, right?
Yeah, exactly. Which is another thing Patrick told me to do. If you're early, you're wrong. So I'm not trying to make any excuses, and I'm just trying to, when I make a mistake, I like to go back and try to figure out where I made the mistake and where my analysis was incorrect. And to me, the part of my analysis that I missed that was the fact that this could spread so quick. And whether I end up being correct and that it ended up being an isolated event, and that most banks are fine and the price is higher, it doesn't matter. In the short run, it's doing this. So I was wrong, and the speed upon which it transferred throughout the system is the part that really shocked me.
Yeah. So I know you were poking fun at me when you put that picture at the front saying, the bear feasting on the KRE. But the thing is I'll admit that I actually didn't short any of the regionals, so I didn't make money from this decline. What I did do one small, reasonably sized bull call spread on FRC, which basically ate it. But the thing that I was surprised by, which is where I actually made a mistake, was I thought there was going to be a rebound sooner in the bigger money center banks. And what I continue to be actually surprised by is that this really is about people abandoning the smaller banks and then going to the too big to fail banks, but yet the too big to fail banks don't seem to be getting any benefit or love from the market at all. The XLF
Patrick,
is down.
I think they fixed
like Bank of America.
But they fixed the liquidity issue, so that's not what the market's worried about anymore. The market's not worried about liquidity, about people taking their money out and doing. They're actually worried about that these banks have gone and lost too much money being long bonds. And if the banks were this stupid and lost all this money being long bonds, they almost deserve it, because there's no reason a bank doesn't need to take interest rate risk. This is the thing that I kind of find interesting is that they all sit and they stare at the yield curve and they say, oh, the bank, borrows short and lends long. There's instruments to fix that.
I don't like what I don't. I find it hard to kind of agree with you. And the reason is this. Okay, when you look at the total credit stock, let's just say the total amount of debt in the system, let's say in the US, the total credit stock is something like $90 trillion. The fact is that when you hedge interest rate risk, it's a transfer of risk from one person to another. Somebody in the system is a bag holder. And when you have one of the greatest bond bear markets in a century, and a wipeout on there, somebody ate it. And the thing is that when there's that much debt, there is only so many bag holders a bank could actually hedge against. The fact is that at some point, this shit was going to end up on the bank's balance sheets, and the banks were going to suffer from it. This is why
I disagree, Patrick. You go look at the yield curve. The yield curve's hugely inverted. It's been inverted for forever. There was lots of times that you could have hedged. The market was along the way was always guessing that the economy was going to roll over.
But again, a transfer of risk. That's not. Somebody's still the bag holder.
No,
Kev.
There's lots of buyers of this thing. Otherwise, the yield curve wouldn't be this way. I completely disagree with you there. I'll take the other side of that trade. That there is no ability.
How is the person? Okay, when when a bank like Bank of America hedged its interest rate risk, who's the one on the other side?
A pension fund that's investing.
Oh, so you're basically saying the pension funds should have been the bag holders on this
right now,
market.
Patrick. The yield curve is inverted, and people are buying the 10-year at whatever it is, 3.5, or I don't even know these days.
I think it's a great idea. Let's make sure the banks don't eat the loss. Let's put it on the pensioners.
No, I'm not trying to say that. You're arguing, Patrick. You're arguing that there's nobody to take the other side, and the banks have to. Take
in the size of all the banks doing it on everything. I think that this is the thing where these institutions are too big and the numbers too many trillions that you wouldn't be able to do it on the entire.
I think the curve would look different, and then I would agree with you there. But right now the curve is inverted, and it's been inverted for a while. And there's been lots of ability for them to hedge it. Not only that,
luckily, at least 3-4 months ago, that there was none of us that were long the financials, thinking they were going to outperform.
Yeah, no, it's
S&P.
been a terrible call for me. I completely agree. I'm not disputing that.
All right, so I'm not going to stop picking on you. Okay, so but let's talk about European banks, because you haven't been long any of those, have you?
Oh, of course, it's a financial. I'm long those too, but I was long, but they were done well. I actually got those right.
But I wanted to talk obviously Credit Suisse was moving opposite to the entire. This is the Euro Stock Banks Futures Index, and the European banks were on fire, almost up 100% in 6 months in what was just an absolutely epic run, and Credit Suisse could not even get an uptick during that period. It was like a death spiral that led to this ultimate bailout. I don't want to get into the details of that. That in itself, there's been dissected so much on the internet that it's not even worth us getting too deep into it. But what was the headline recently, though, was Deutsche Bank. And clearly still breaking to a lower low. You look at Barclays breaking down. There's a number of these European banks that just continue to be weak. I mean, what's your take on what's happening over there?
I think that the banks are globally for sale. and that it's a shoot first, ask questions later. And one of my buddies that's on the sell side had something really good to say the other day. He said, there's a huge basket out there because it seemed to be, it wasn't, the KRE wasn't trading. It made little sense given all the news that was coming out, the way it was trading. It's like, there's this huge basket out there. Feels to me like someone's trying to get these off the sheets for quarter end. I feel that's what's going on. We're 1 week away. They probably need the liquidity. Maybe we have another few days of selling, but I think we're close to the end of these things.
Look, at some point, I do not believe that we are going to get a collapse of the banking system yet. If there was going to be one, I don't think it all just happens at once at this moment. I'm a seller on the idea, which is that if that's the case, then all of these banks in the next couple weeks are going to have a reflexive rally. And by no means do I think they're a long-term buy and hold, or nor do I believe they're going to return to their highs. But if by next week, if we see Deutsche Bank trading at $7, playing it for a reflexive rally back to 10 is a quick, pretty solid return. Those types of, but those are trader trades, right? Those are ones where you have to get in and get out. You can't, your holding time might be a couple weeks.
Okay, Patrick, what would you give me in terms of odds, and we'll do them in stakes or something like that, that Deutsche Bank trades at new highs this year?
This year?
Yeah, before the end of the year.
When you say new highs, I mean, are we going for
this year?
Because
are we this year?
This year? Because I was saying like the highs of $55 here.
It's not going to do that.
No. Okay. But the high of this year was up here at $17.
No, this calendar year.
Because
you said that there.
I put it weekly. Yeah. No, this calendar year. Okay, so you're talking $13.50.
Yeah.
And it's down at $9.35. Yeah. So I'm giving you. Well, yeah, I'll take that, but I would give you 2-1.
Okay, so how about we do this: a Wagyu versus an Alberta beef steak dinner.
Okay.
So if I win,
you get the Wagyu.
But the only caveat being that you're going to cook it and you're going to give me you're going to do the
and no worries.
You're going to do the chimichurri sauce.
Yeah, that's for sure.
Because then I win no matter what, so it doesn't matter.
With some nice blackened lobster.
Okay, so if yeah, that's right. He did burn the lobster. He's good with the beef, not good with the lobster. Okay, so if Deutsche Bank takes it a new high, you're gonna buy and cook a Wagyu steak for me.
Yeah, and if it doesn't, then
I get you an Alberta beef, which is still a
but I want a tomahawk, buddy.
I don't know. Okay, we'll see. Okay, you're on.
Okay. All right. So, but anyway, back to the thing. Like, I do think we're going to get a bounce, but on the short term, you're right. Like these things, there's not a lot of clarity. Will the Financial Stability Oversight Council do something over the weekend? I mean, they did. It was nothing that came out here, but like, are we going to get some sort of news that suddenly changes the sentiment Monday morning? It's always going to be at risk. But right now, there's zero technical evidence that the turn has happened.
Can I tell you what, in terms of sentiment, I'm looking for? Because a lot of people are talking about, they're going to do the deposit insurance and that's going to change it. And I don't think that's the issue. I think that people, it's a confidence issue in terms of what people are worried about it on the sheets. I think that we're going to get a Warren Buffett convertible bond or convertible pref deal, and that will be the sentiment change. And did you see that the fellow that made the Twitter the tweet storm where he went through and went to how many different private jets, how many different private jets went to Omaha that weekend? It's like there'd never be so many private jets there ever. It was shocking. So that's what I'm looking for. I think that the only thing I worry about is that he might be old and he might not care, or he just might be trying to drive too hard a bargain. But to me, it feels like we're going to get another one of these situations where he's going to come in, he's going to buy some it's a convertible preferred. It'll be the sweetest deal for him, but it'll also be a win for the bank that's doing the trade, because his endorsement will send it up. We saw this obviously in the great financial crisis, but we also saw it, Patrick, with Home Capital in Canada.
Yes. Oh, that was
so.
huge.
It's not like this is just once he's done this. He's done this, a couple of times.
The white knight shit has been his specialty.
And I'll be really surprised if we don't get that sort of announcement. And I think that'll probably be the turn that we need.
Right. I had to eat a hat about that Home Capital.
Yeah.
That
you
was,
didn't
that
actually
was
eat it, which is bad. You should really have had to ingest it, at least part of it.
Well, I should have. I mean, they took the effort to make it for me.
Exactly.
But it's anyway, I want to talk some more charts then, and I want to go back to talking about what's happening in the S&P, NASDAQ, and Russell. And so S&P 500 really has been flat throughout this entire little financial instability, let's call it, just so we don't use doom words. But it really has brushed it off. But where the real kind of money flow has almost completely been, it's been pressing the NASDAQ.
I know, it's unbelievable, isn't it?
It's not just that the NASDAQ stayed stable.
It went up.
The NASDAQ, whatever, it's like up 8% or something. I'm obviously rounding here, but like during this whole shit show, it's up like 5 to 8%, and those FANG stocks are thing, and it kind of reminds me a little bit of 2007, where after those two credit hedge funds blew up a bear. The market dropped like 12, 15% or something in the summer of 2007. You remember that, right? And then the market proceeded into October to rally still to a higher high. And correct me if my memory fails me, but it was like the energy names and stuff that were like the leadership in that cycle. That was where, like, back then, which Exxon, I think, was at the time the largest market cap company.
But Patrick, I think it was more than that. I think that they came back for the real estate, like the home builders. Let's pull it up because I think you're correct. Let me look up when the Bear Stearns went, because I remember
it was in the summer. It was like, you can tell the crash date because like you can see that there was only like a 1 month sell cycle in the summer, so you can immediately see where it is. But what are you talking about? This 2007 summer? Like, come on. This is the Home Builders Index, okay, buddy? Like, what rally are you talking about?
No, then it was okay, it was before that, because I remember.
Listen, you're being terribly wrong. That's all. The fact is that anyway. The point I'm trying to highlight, though, irrespective of whether thing is that the market still managed to make a new high in October 2007 because of a couple of sectors within the market that were the biggest market cap names, took big money flow, and in spite of the banks continuing to eat it throughout that period, the S&P still managed to make a higher high. And what I'm curious about is whether this time around the NASDAQ, in particular those FANG stocks, can play a similar role where the NASDAQ goes ripping to, let's say, 14,000 on the upside to retest the August highs. Apple and Microsoft and NVIDIA and all these other ones continue to just storm along, and yet things like small caps and financials and a number of these other sectors just don't make any robust recoveries. They'll bounce, but no robust recoveries. And that kind of will start to show more clarity in terms of how the rotation is actually occurring. Do you think that could happen?
Oh, for sure. And Patrick, by the way, I went and looked it up. You got your Bear Stearns. The two hedge funds collapsed in June of 2007. Mm-hmm. And so we did get.
Here, let me pull up the S&P back then. So
you have
going
your,
back here,
because it was the next year that everything collapsed.
Yeah, no. But this was that 12 to 15%. Let me just see. So here was the summer drop. It was a 12% drop, about 193 S&P points that occurred in a span of 30 days. Right. That was a clean correction, and then the market here managed into October of 2007 make a higher high.
Yeah.
right? That's what I'm talking about.
So you're thinking?
And-
So you think that we have a similar situation going on here?
Well, I don't think the S&P goes all the way back to, let's say, 4,800, but I think the NASDAQ can go to 14,000. And maybe these summer highs in August and in February can be beaten, like 4,300 on the S&P. Like, could we see, I'm just asking, could we see a scenario where these FANG stocks, because think of it, if the banking thing calms down, and all of the banks just do a 50% fib retracement on their really oversold conditions and just reflexively rally, and the FANG stocks continue their momentum, then the market only has room to go up,
Well,
right?
what's the
And
world coming
it's
to?
gross.
This-
I feel dirty. I feel dirty for saying this, but like the question though is that going to be the big fake out where everyone FOMOs their way back into the market because they see that everything is fine, the financial crisis averted, everything is thing, and that puts in the year high.
Okay, could be. I hear it.
I feel that that's a very reasonable chance. I don't want to say that. Look, I always like to say that the unfolding reality before us trumps everything. So we'll see how this develops. But I like this analog. I like this, and I'm going to be stress testing with members to see whether or not this is how things play out. We'll kind of give everyone updates as we do this episode more.
Can we do actually NVIDIA? I'd love you to.
Oh yeah, let's look at like unbelievable. But poor NVIDIA, like Kramer gave it the blessing.
Yeah. Well, listen,
Like-
Patrick, this was a huge win for me. Do you know?
Was it?
Because I'm not short. I'm winning. I'm winning every single day that this thing goes up, and I'm not short because I know a lot of people that are short, just going, "This is so stupid" or whatever. I go, usually I'd be short with you, but I don't know.
I'm not short, but boy, has this been the leader in the basket, right? But I mean, look, but listen, Microsoft looking great, made a little bit of a higher high, still a very clean trend. You take Apple, which has been resilient throughout this period. Like the consolidation was a nice, solid little, almost like an ascending triangle. This break targets 175 on the upside. These FANG stocks could just keep, like even Meta, which was the dog shit, has been like ripping to the upside. I mean, it's 100% off its lows.
Yeah, I guess if you didn't know what this did and you looked at this chart, it's hard to argue that that's a bearish looking chart.
But I think it's overdone.
Yeah, it's overdone.
That doesn't mean
it's being bought. You know, like there's no doubt about it.
You know what? What if this is all a sell in May and go away? What if the next month is just the market having a rip? Like everything, the financial things just calm down. It doesn't mean it's all over in the long term, but everything just calms down. Suddenly, everyone just goes temporarily risk on for a month.
Patrick,
rally.
you're gonna lose all your doom cred if you keep talking like this, bud.
Look, I still believe we're going into recession. I still believe the market makes lower lows. There we go. I don't want to confuse people. Okay, so. Anyway, what I also wanted to just touch on, obviously I wanted to talk about crude oil here for a moment. Like, what a nasty break.
But we knew this
that
was
happened.
coming. Like we sat there and we
We?
said, you can't keep pumping up against that support and not have it break.
Yeah,
The real question
there's no
is, are
such
you
thing as
feeling
a double
feeling better about it? Like, do you feel like you might like it now?
I bought 65 with members, buddy.
Oh,
we
good.
freaking nailed it right at the bottom, but I faded it only for this bounce. And the chart is still incredibly bearish. And so there's this old saying in technical analysis, what was previously support acts as overhead resistance. And if you look at where, let's say, all the high volume nodes or where the major volume traded on crude oil, you can observe actually. Sorry, that's because I'm looking at May. Hold on, we have to look at the continuous. There we go. So you can observe here that there's huge amount of volume that traded right in the middle of this 4-month sideways consolidation zone, right? And the way I look at it is if oil rallies and bumps its head right into that, then you can't say anything bullish about the technicals. And if that happens, there could still be one more trip down to 60. Now, I do want to highlight, I am very bullish oil into the longer term. But clearly, as there's a risk that we may end up seeing an economic downturn, maybe it's one of these things where oil just keeps selling until a recession is somewhat confirmed, and then it just starts ripping afterwards. It might be a thing that this is a more of a second half of the year story, and us screwing around with it in the first quarter is just like you trying to buy regionals 2 weeks ago. It's like at some point there's going to be stupid money made in long energy. It's just when. I mean, that's what makes you the money, is answering that question. And this chart still is pretty bearish.
One of the things that's shocking to me is how Biden has gone and done a rookie move. A rookie move. He's got his bid. He's got his price. Market comes down. It looks like it might fill him. And he pulls his bid.
Well, he pulls the bid because in the end, this is helping his image by suppressing inflation. But listen, what I want to highlight, okay, look at the 3-month performance right here in the middle, this one right here. Look at the sectors that have outperformed and look at the worst performing sector. Energy by far. There we go. Energy by far the worst performing sector.
It's pretty hated now, though, Patrick. I'm going to stick my neck out. I'm going to say that it's time to start buying it. So 2 weeks from now, 2 weeks from now, everyone else should buy it.
Yeah, well, actually, I won't lie. We published a whole repositioning at Big Picture Trading on repositioning last week. So over the last week, so we're actually already dabbling with that. But the point, though, is what are the other sectors? Remember, you love these industrials, basic materials, and these kind of spaces. They've been pretty flat. It's really been the high beta, very cyclical names, the technology consumer cyclicals that have been ripping, other than financials, which obviously have a unique problem. But really, the underperformers have been those defensives, right? The utilities, the healthcare, real estate, consumer staples. These things have been where all the weakness is actually thing. And a question is that when will we see that flip? And I think that will come as we approach wherever this market is going. Like, I think if the scenario that I suggested where the market kind of first goes higher before lower happens, then I don't think the flip is yet. I think that, the rally is going to have to come on the back of the FANGs and other types of names like that. So maybe that rotation back into the defensive names is as well something that happens in the summer.
Okay.
Right. The other, what else is there? Unbelievable that so many of the basic material names or commodity names just have been stuck in the mud. Like copper can't get out of there. Out of that trade range, nat gas right back down to its lows, uranium, which was in a beautiful kind of a nice trend that was lasting much of this into into February, suddenly back to the bottom end of its ranges. Did you see what's like happening with wheat? Like and these ag stories, wheat right at the bottom of its range, corn relatively weak, a little bit of an uptick, but the beans as well just broke right down. And there's even lumber. We're going into a recession, and commodities are simply stuck in the mud. Now, I mean, the worst really was last year, but there's just no love coming to this space at all.
No love.
No love at all. And the question is, do you think that commodities will do one of those scenarios where they'll start to rally before we're out of a recession? Assuming we even go into recession, you might not even agree with that. But I'm kind of thinking that this is happening because some sort of an economic slowdown is clear that is in front of us. And the question is, once we're in the midst of some sort of confirmed slowdown, we won't even call it a recession. Do you think that is the kind of condition from which, when there's some sort of a sign of a green shoot, that the next major commodity cycle begins?
Yeah, and I might argue that gold has started it.
Well, gold is leading. That's a whole other story,
right? No, but it's kind of the similar. Like it's doing well because of the fact that people are scared about the system, but it's also doing well because the rate. The market is pricing a lot,
Real rates,
lot
but also
less, interest rates to be a lot lower 6 months, a year from now.
Well, this is the whole point. I think that this was very much about the fact that we are what was supposed to be an advertised, pivot and subsequent monetary easing cycle. Everyone was talking about 2024, and with these bank crises, suddenly everyone's like, no, like the Fed might be forced to pivot sooner, and because we kind of accelerated the rate of which what stage we're in that monetary cycle, gold suddenly came to life. Would you agree with that statement?
Yes, I would agree, and I would also say that the instability of the financial system also helped. And then I think that at the end of the day, I'm still a believer that we're in a gold bull market because central banks are going to increasingly use that as their truly riskless asset. Because
we're literally $100 from all-time highs.
And you know what the thing about it is, Patrick? Almost nobody cares. Usually at $100, there'd be a lot more talk about this and a lot more excitement. The other thing that's interesting, Patrick, is the fact that the gold stocks have really struggled and are way behind.
But they're starting to catch up.
They're starting to catch up, but they're cheap. Like if you're looking at them versus the actual.
Oh, yeah. Like gold is at near its all-time high, and we're still $15 off.
We're like a third off of its high.
Yeah.
So that might be something interesting to look at.
Well, that will be certainly what I wanted to leave the session with. Obviously, it's been a hard go to be short bonds, right? Like the 2-year ripping, the 5-year ripping, everything is ripping higher, and especially even today, another go at it. So I feel sorry for any bond bears.
Well, I don't feel sorry for the bond bears that do it through steepeners.
Well, I was about to say the only thing that could possibly have saved a poor lad would be if they were long the steepener, which has been certainly a fantastic trade. And congrats to you for at least being. But we'll talk about that when we talk about our bet. But I got lucky. That was close.
Yeah. I think,
but I mean that's because you knew the financial crisis was imminent,
exactly,
and that's why you made the bet. But you were just once again early on calling the financial crisis by 2 weeks.
Now, one of the things I will say though, you're mentioning the bond market, and you're talking about it ripping. But if you actually go look at those charts, go look at the 30-year. It's not actually doing as much as you're making it out to be. And
the 30-year has been the laggard.
I want to say though, Patrick, is that the volatility at the front end has been enormous, and I don't think that people that don't transact in that area probably don't realize the magnitude of the moves. These have been truly epic things. I did something where I went through and I did the 5-day historical volatility of all the different instruments. And if I go look at the 4th dollar future, or let's just say the 2-year, these sorts of moves are such that they are on par with 1987, the great financial crisis, and this. But meanwhile, when you go look at the S&P, it's barely the banking crisis. You could almost not see it. When you go look at the long bond, yes, it's gotten more volatile, but nowhere close to what's happened in the front end. So this has been completely a function of the attitude the expectation about future Fed policy as being the most destabilizing part of the financial arena.
Now, did not one fund just shut down because they ate it on the 2-year?
I don't know. There's been some big painful things because on the whole,
there's been some huge.
The trade of last year was to assume that the Fed would keep hiking, and then not only that, they also had they had flatteners, and it was a great trade. Yeah. And as like almost everything on Wall Street, they took it to an extreme and they took it too far, and then everyone tried to get out at the same time, and the pain has been enormous. And I really think that most folks deal in stocks, or if they do trade bonds, they'll trade the long end or just an ETF. They probably don't appreciate the the magnitude of
highly
the
leveraged.
moves that are occurring at the front. It is just astronomical, Patrick, and it's lots of pain.
Oh yeah, because if you're in some like risk parity,
No,
fund
not
and
even
you
risk
just,
parity.
like,
These are just people that transact at the front end, and the
yeah, but they do it in size because of the low
right.
volatility.
And there's they probably just had the longest week of their lives. Like it was that
Yeah.
it was that
2 weeks anyway.
Anyway, so I think that you should go have a look at that because it.
But
sorry, go ahead, Patrick.
No, so what I want to move on though, which I thought was the most kind of interesting thing that I don't know whether it's a tell yet or not, but I wanted to talk about junk, like the high yield credit, because while obviously treasuries had a big rip because of monetary policy potentially shifting and everything changing on that front, what did not uptick at all was junk or
Do you know
high
what, Patrick?
yield.
I'm sorry to interrupt,
And-
but if you type in junk H, or no, sorry, HYGH, you could see the just the actual credits portion of that only.
Yeah, well, that's almost inverse. I was going to literally show the credit spread here.
Fair enough. Sorry, I didn't realize you had that.
Through yeah. So I was going to talk about that. But the point though is that it wasn't that credit fell; it just didn't rally with Treasury. And the thing is that will this become a trend? Because I've heard a number of people reference that typically credit spreads start to blow out about 25 to 30 months after a rate hike cycle is ensued, and it's way too early for credit spreads to be blowing out based on that metric. But what if this is all accelerated, and what if this is a new trend? And I don't want to call it a new trend just a couple weeks in, but the fact that we're seeing credit spreads rising as junk bonds didn't even uptick on basically a big treasury bond rally may be just showing that A, there's a lack of liquidity for them, and two, that maybe people are starting to worry that this is going to cause an economic downturn, which causes default risk and other things to have to be factored in here.
Yeah,
right?
there's the Patrick I know. Back at it.
Yeah. I love it. I couldn't disappoint you, buddy. All right. Any last thing you want to look at? Are we good? All right. That was talking charts. That was a good session, bud. All right. Let's go on. It's time for our new segment, VWAP, videos we analyze and pull apart.
Yeah,
I like
that's a
the
great
name.
name. Thanks to Efficient Market. That I think that's his name on Twitter that came up with that. It's terrific.
Hype. He has hype in there somewhere, right?
Yeah, he says right. Efficient Market hype. That's correct. Okay, so the first one we're gonna do is Bill Dudley, former FOMC member, and it was someone that actually, I think he does a good job because he's not quite as bombastic as El Arian and Summers, and he also offers a better kind of insights into the working of how the FOMC works. All right, so here we go.
What's interesting today is the market reaction to the Fed's the press conference and the statement and the summary of economic projections was to be ever so slightly surprised by the rate hike because it wasn't fully priced in, but actually it's pricing in more rate reduction in the rest of 2023 and into 24 than they were earlier. And I think that was a little bit surprising, frankly, given the fact that Powell was very clear. We don't expect to cut rates in 2023.
Steve Chivarone of Federated, I keep going back to this because I think it's a really salient point. This meeting marks the passing of the torch from inflation and duration risks, he wrote, to recession and credit risks. Arguably, what we have seen is not a credit crunch. However, often liquidity crunches can lead to credit crunches, as we've seen in the past. Bill, do you agree that this really is a tipping point as represented to some of the changes in the statement?
So, Patrick, I want to ask you, first of all, do you think that that's happened? Do you think we've moved from being worried about inflation and the market too hot or the economy too hot to one where it's actually a function of worrying about credit and worrying about a deflationary collapse?
I believe that the economic engine has a very important input of consumer sentiment and business sentiment and things like that. When you have uncertainties, a lot of people hold back decisions and do things. I believe, and more importantly, when institutions like banks have these kind of conditions, they're a little more hesitant to make a loan that they think has any risk associated with it. I do think that these things create feedback loops, and so
Yeah,
it is
I agree.
risk.
It's a risk, but
Obviously,
did it
this is the
switch?
bear in me.
Did we switch from, like, this week? Did we go from being worried about the heat to the cold? I don't know. Let's listen to Dudley.
Really depends on how broad and how long. I mean, we've had other examples where there have been all sorts of market turbulence and no recession resulted. The most obvious example of that was the 1987 stock market crash, where people were talking about making analogies back to the Great Depression, and the economy didn't go into recession at all. So I think the real issue here is how many banks are affected and how strongly do they react. When I look at the U.S. banking system today, I see only a handful of banks that have actually been affected, and they only account for a few percentage points of total banking assets. So I personally think that if this thing is stabilized right here, the effects on the real economy are going to be pretty modest.
Oh, I just puked in my mouth, dude. Like, that sounded like a Kevin Muir statement if I've ever heard one. No, I don't agree with that at all.
That's hilarious. So the economy's doomed. That's good. It's good.
Not doomed.
So to be clear,
it's
then,
not
Bill,
doomed, but it's
Well,
not.
sorry. Let's go on to the next one.
Yeah. Okay.
Important point, because we're only 2 weeks into this. If it doesn't spill over and carry on bleeding, are we going to go back to what we were talking about 2-3 weeks ago in another 2 weeks?
We very well can. I mean, I don't think we'll have the clarity in 2 weeks, but 6 weeks from now, the next FOMC meeting, maybe we're back in the situation where, the banks that were under pressure have either remedied themselves or been acquired, and the rest of the banking system is fine, and the economy is still too strong, and the labor market is still too tight, and inflation is still too high. I mean, the reality is the Fed actually hasn't accomplished much yet in terms of generating more slack in the labor market or actually bringing services inflation down. And that's important to recognize.
So, Patrick, what do you think the chances of him achieving that where 6 weeks from now, the FOMC is raising again?
I still think that's on the table because while I believe that the impact of these rate hike cycle will inevitably lead to a recession and all these different things, I also don't believe that this is doom and gloom bank failure. And so there will be a moment where these banks are going to stabilize off of all of this. And then there is going to be a reflexive move higher, and that might create the condition from which 6 weeks from now Powell will just keep leaning into a new rate hike.
You do like Dudley.
No, because his earlier statement I didn't. But the point though is that I still think that there's a recession coming, and I still think there's a thing. But I don't think that this is doom for banks. But I just
it's going to be doom in another way.
As soon as
all right, okay. So now, Patrick, the next one is Barry Ritholtz did a terrific interview with Cliff Asness on Masters in Business, and for anyone that's interested in hearing a quant go through different things and talk about different strategies, I highly recommend it. And not only that, I know that Cliff is a little abrasive on Twitter sometimes. I'm really kind of beginning to like him a lot. Let's play this clip because it's interesting. It's going to be up your alley because he's talking about options, and he's specifically talking about options versus CTAs or trend following. And he's discussing something that Cem talked about, how these options didn't save you in 2022. But he also talks about some discussions, let's call it, that he's had with another famous investor.
But last year was a blowout year for both trend following and even the more general macro investing that considers relative value. And it's exactly the year it's supposed to help in. Consider a rival insurance strategy, always owning puts.
Mm-hmm. That sounds expensive.
It is expensive.
And sounds like it doesn't work most of the time.
I've had huge Twitter fights with Nassim Taleb about this.
By the way, you and Bose Weinstein both seem to go at him politely about, and you both have the math chops to do it.
I did what I always do. I started out politely. It didn't necessarily end there. And I will say I think Nassim's absolutely brilliant. He's just also insufferable at times.
It's a dangerous combination.
And, you know,
Patrick, that's what I say about you in terms of at least half of that.
I may be less brilliant and less insufferable, but I might have some of the same characteristics, which is a dangerous mix.
That's what I say about you.
So a strategy he's been involved with for a long time that kind of corresponds to his Black Swan book.
Sure.
Which it's a very good book.
Yeah.
It basically is a one-liner. Giant things happen more often than
we expect.
Than, quote, normal distributions say. But it's an important message. He got very lucky that he wrote a timeless message about an hour and a half before the GFC, right? But my colleague Antti Ilmanen is getting very lucky in that same. He wrote a book called Investing in a Low Expected Return Environment right before 2022. But the strategy Nassim favors is buying insurance through the options market. Tests of the simplest form, as my colleague Antti has done, say that loses a boatload of money, including its huge victories in crashes. I have no problem with someone like Nassim saying, actually, we whoever he works with does this much smarter than pure rolling of puts.
It's not equal size every year. I bet there's a million other ways to spin that.
But he doesn't like the basic finding that Antti is that he wants both, and I won't give him both. Puts work really well in crashes.
Yeah.
Right. March of 2020, October 19th of 87, huge. Their leakages in terms of premium over the long haul that doesn't have crashes is larger than what they.
Patrick, I want you to know that as you get older, you also will suffer from leakages.
And there are some bear markets that they failed to help with. They did not particularly help in 2022. There was no crash.
Too quick.
No, too slow for the puts. In 2022,
down 34%, and then you snapped right back.
Oh, that was March of 2020.
Oh, 20. I'm sorry.
No,
I'm sorry.
You had it right given your time period.
Yeah.
The puts helped like crazy then, and managed futures didn't. In 2022, managed futures helped like crazy because it was a long, slow developing
6 months
thing.
to the low in June
And puts, I don't think really helped at all. The premiums got very high.
Yeah.
And there was no big crash. And that's not an environment. If you like puts more than I do.
Can I comment here?
For sure.
So my problem with that statement is everyone believing that this equities were the problem in 2022. But the 2022 was not a huge bear market in stocks. It was a devastating bear market in bonds. And stocks had to reprice based on it. I think that if there is going to be a major downturn in stocks, it's going to be under different conditions, like contraction in earnings of the S&P 500 and other things that could be driven by a recession. And this idea that the puts were supposed to be a big hedge last year is not where
Patrick,
the problem was.
He goes even over the longer period. It doesn't work. Okay, let's just keep going. 1 second. You know what? Okay. I'm sure he runs one of the largest quant funds in the world, but I'm pretty sure you're correct.
Yeah. Let's go.
Lower. A portfolio of the two as an insurance product could make a lot of sense because they hedge different things. Puts hedge bolt from the blue crashes, and trend following hedges long slow crashes. I will make the self-serving claim that long, slow crashes tend to be more deleterious to your wealth long term. A lot of short term crashes reverse soon afterwards. They're really about surviving.
Right.
So I will make a small commercial for how we do it. But if someone a little bit more reasonable than Nassim wanted to go, all right, it is costly, but it's less costly than you think, and maybe we should combine these two.
Right.
I'm wide open to that. But.
All right. So, Patrick, let's talk about this. One of his arguments is that really what you shouldn't be buying are puts, hedging for crash. You should be doing trend following because it performed better. And one of the things that I think is interesting is that, he recorded this a couple of weeks ago, but in the meantime, those trend followings that had systems that had worked so well for 2022 and even for the start of 2023 have actually been part of the problem, especially at the front end of the curve. And like, if you could pull up a couple of charts for us right now, and let's do DBMF, which is Andrew Beer's fund, and this one is trying to replicate what the positions that are held across the trend following universe. So it's almost like an index. And you'll see that in 2022, it went from $25 to $35, even as everything was getting killed, right? So it did provide you a hedge against your 60-40 portfolio going down. And you alluded to the fact that bonds did worse than stocks and dragged stocks down. But what's interesting is that in the last little while, it's gotten absolutely crushed. Like just destroyed. And it was all those positions at the front end of the curve that ended up being.
Well, absolutely. I was about to say the 2 years.
And it was, well, they also were doing SOFRs and euro dollars. The other one is CTA. That's another, that's a simplified one. So that's the Mike Green / Harley Bassman firm. I don't know if they're involved with this one or not. I don't think so, but this is another one. And this one's a little more diversified. So it probably hasn't done as badly, and it's a little bit different because the DBMF is
not a crazy different percentage down. I mean, that was a horrendous drop in just 2 days. That was definitely the 2 years. That happened 2 weeks ago.
So what's interesting about this is that if you're sitting there as a quant and you have, let's just say, long some sort of a stock or risk on strategy. Let's just say that you're long risk and you're trying to take advantage of the risk premium that you earn over time. Not only this past couple of weeks did you get crushed on that side of the equation, but you also ended up getting crushed on your trend following portion of it. And part of the reason I think this is why we've actually seen oil go down.
And certainly S&P put protection would also be doing
Oh, yes, exactly. And, you know, and in NASDAQ, if you were dumb enough like me to be short that thing, then you would actually be offside. And so one of the things that I think is interesting is that I think that oil cracked support and went lower as part of the VAR risk-off move that was experienced in the wake of the SIVB announcement. And that's what we've experienced across the board is a huge de-risking of all sorts of things. And so the positions that were held by the kind of smart aleck hedge funds or aggressive accounts, those were the ones that were liquidated the most. And I always told people, I said, be careful in these environments of reading too much into moves, meaning that saying, oh, the economy must be saying this because of this. No, it could just be that this is liquidation or covering of shorts, and that's what you're really doing. All right.
Right.
Yeah, good stuff.
Good stuff.
That's the end of the segment, buddy.
But you know, I feel though the one thing I will just comment on hedging with options is the one thing I will agree with is a systematic approach of rolling protective puts as a hedge is generally proven to being a strategy that fails. There is no doubt in my mind that to use, especially if you're long gamma, not using it as spreads or some other way like collars to eat away at the premium you're paying, you do need to be outright tactical about when you
Is there anyone that could help him with that? Maybe like somebody who has a firm that does that?
Okay, anyway, no shameless plugs. Let's move on. Okay, so let's get to skin in the game because this is more interesting.
Oh, yeah, you like the ones that you win. So I sure was wrong. So what was the bet? It was
Oh, well, no, it was so close because the banks started to move right on the last day. And so we bet, so we, just to clarify that to listeners, we did the 2s, 10s. We did an over-under at the minus 873 basis points or whatever you call that.
No, it's not. Is that
how I would say?
87 points.
87 basis points. Thanks.
Yeah, no problem.
I just saw the amateur hour here. And so the point though is that you just made a random call that this was the turning point and it couldn't get more negative. And come Wednesday, it was at like minus 110 basis points. and I was already like a rock star, thinking, "Oh, this is easy and everything," and then on Friday it goes in 2 days.
Oh my God, I was closer than I looked.
Oh yeah, like literally it reversed, and it essentially closed at 89
Oh
basis
my
points.
goodness! And then it opened up at 75 or whatever.
Yeah, and then Monday it opened the thing. Like I survived. But how what's the term I use by the hair on my teeth?
Oh my goodness! Oh well, good for you. Good for you.
But no, I got lucky. But then again, see, because you knew
right.
the financial crisis was imminent,
Just like
and the banks were about to fail.
The yield curve knew COVID was coming as well. Like, because everyone talks about the fact that the curve went inverted, and then COVID happened, and then everyone's joking and saying the yield curve knew that the COVID was coming. Okay, let me tell people about skin in the game.
It is our
weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager. The other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode. And the first one to 50 has to take out 3 lucky or unlucky listeners, depending on how you think about things, to a dinner. Okay, and so we're now at, is this up to date? 2832?
Yeah, this is up to date. Yeah,
picking away. You're coming back. Good to see. Okay, so what do you got for us? We got to do a new one.
You know what? I was lucky, bud. I was lucky. You know what? I don't know. Should we?
No, you got to do something.
Like, I really want
new. We don't want 2 in a row. You're not allowed to do that. Nah. You got to.
It's so tempting. All right, then we shall bet on the.
Oh, come on! Seriously? Okay, you can do bonds.
Yes, because I know you. Okay. All right, then I'm doing the dollar. Okay. Let's go to the Dixie. All right, because that way or actually no, even better. Let's go to your baby.
No,
the US dollar yen.
Because then at least I won't be as conflicted. Oh,
no,
God,
that's why I want to
fine.
go to the US dollar yen.
What do you got for me on the yen?
You're conflicted. Okay, so you know what? No, it's been in a downtrend. I'm gonna give a little bit of an edge. I'm gonna use the 131 even.
Oh wow, you're
just a little bit higher.
Ferris
straight up
you're
over
my
under.
hero, giving me an extra 29 pips. What a guy! What a guy!
Over.
Okay.
Over under.
You're just over under from 131? Yeah.
Over under. Yeah.
I gotta take under. Like, for those who don't know, that means Japanese yen strength. Okay, so I'll take it.
Yeah. It's okay.
131.
All right. So
it's probably
131,
close,
and you're taking the under.
131.01 or something. I'm gonna lose another one.
So what do you? How many points do you want to do?
By the way, you were the real loser on that yield curve bet. Because I think I said anywhere from 0 to 18, and you chose like a wimp 3. So you're 4.
No,
okay, whatever 4. It was.
We chose 4.
You could have made it to like you could have been way ahead.
No, I couldn't risk, because then if you won, then I would have never been able to.
Well, yeah, because I would have been. I would have been at 50.
I wouldn't have. That means I would have been. No, that would have put me on tilt. I would have. I got to stay in the game.
Good for you. Not trading on tilt. Very disciplined of you. I'm gonna be disciplined as well. Let's do 3.
All right, that's good.
I know. I don't want you
within
to
a
be
stone
actually
throw if it
already
works.
tied, so I don't want to do anymore.
All right, so 3 points. I accept this. I accept
good.
3 points. Okay. All right, so let's move on to no stupid questions. We got 3 questions. They're sort of more in your camp, so I'll read them, and let's take a shot at this. So, hi everyone, just catching up on my favorite bi-weekly podcast. Yeah. Which one is that? I don't know. Anyway. Lovely to hear you like Philomena Clunk.
Kunk, it's Kunk, yeah. And Patrick,
Kunk,
I am
Kunk,
so proud of you.
Clunk.
I saw that name and I thought, there's no way Patrick's gonna get that name. I'm like,
I fuck up the last name.
I would have given you 4 or 5 to 1 that you weren't gonna get it. You're like, awesome, well done. Yeah, that's
and then
right.
I fuck up the last name.
The four-letter one.
Where's that L in Kunk?
Well,
It's just such an unnatural name. Kunk.
Maybe there is people named Kunk, but I doubt it. I think it's a joke.
Anyway, so Netflix got that off of BBC. Diane Morgan is a wonderful actress and finally got some international recognition. You'll love the series Motherland on BBC as well. Have you watched
that?
that?
List.
There you go. So 2 quick questions. Emerging market suggestions from last podcast. Trading emerging market currencies being a better choice than owning ETFs. You said it pays 10% for the carry. Is that the overnight rate that Brazil or Mexico pays? I only have access to CFDs this side of the pond. But are you telling me that if I go short US dollars against the Mexican peso, I get paid the overnight rate on top, as that is welcome news to me, unless I need something like Interactive Brokers?
Yeah, sure. So I had to go look it up because I don't
Okay.
trade CFDs, so I'm not familiar. And the other thing is that I might have said that Brazil's yielding 10%, but it's actually the difference between Brazil and your base currency that matters. So if Brazil's yielding 10 and US is yielding 5, I'm just picking numbers, then you'll actually only earn 5 on the carry. It's the difference that matters. Now, in terms of CFDs, and for those who aren't familiar, it's contract for differences. I looked, and it does seem to be that there are what they call overnight rates, and or what do they call it? Not over.
That's correct.
Yeah,
it's like the Forex
so
markets. Yeah.
There is overnight CFD financing. So there is a rate that you will, yes.
Have a positive
now,
carry.
the difficulty is that when you trade something like this, that is not a standardized contract, that is that they're able to influence the price, chances are they are not giving you the greatest rate. And I don't know, you'll have to go check, but it wouldn't surprise me at all if they're giving you none of it. And that's how they're earning money, is by pocketing that 5% for themselves. And one of the nice things that, like if you go to Interactive Brokers and you borrow, let's say $50,000, let's say you bought $50,000 of pesos, then you would get one interest rate. But if you did $1 million, you get another interest rate. And if you did 10 million, you might do another interest rate. One of the nice things about futures is that futures are a standardized contract that is arbitraged by banks. So although there is some variability in terms of where that arbitrage will kick in, on the whole, that is a institutional, and even better than institutional, a bank funding rate. So in essence, the futures are a much better way to earn that carry if you're trying to do it. Because whether you do it, the future, or, Stanley Druckenmiller does the future, it's the same price. There's no difference. They don't find a way to arbitrage out, and charge you more because you're a little player. So that's one of the reasons that I like futures better.
Right.
But anyways, go look it up. It's the overnight
Right.
CFD financing rate is what you should be looking up and seeing if you earn, or in fact, you might even pay. But my suspicions is that it is
going to be a positive carry.
My suspicions are that you'll be much better off trading futures if you can. Yeah.
Oh, that probably I would agree with too. But they will still have a positive
I think
carry
that the
at
pushback
CFDs.
to it is that futures are large, or sometimes for some people are too large, or they want to leg into things. And if you're not holding it overnight and you're just trading back and forth, then it doesn't matter. Like if you're just buying Mexico in the morning, selling in the afternoon, it doesn't matter what you're going to earn because you're not earning it overnight. It's only if you're putting a trade on where you're buying it, leaving it, then there's better ways to do it. And if your CFD isn't giving, or your CFD company isn't giving you enough, maybe go shop around for that. I don't know. I don't know anything about CFDs, but I do know you can go look at it and do some more digging.
All right, so let's go to the second question. So markets ahead, if the Fed continues offloading its balance sheet, isn't that bearish for markets and unprofitable inflated sectors with high PEs? Are we forgetting don't fight the Fed? Because I sure did in 2022. Thanks so much for making the podcast intelligent, funny. It's also much needed doom porn antidote.
I know. I try to keep Patrick's doom porn down. Yeah.
Yeah,
But you
I was
always
about
need
to
a little
say,
bit of
'cause, like, you know, if you-
scintillating, just a little bit. Think about it as like HBO Max, or Cinemax, like what we watched when we were a kid. Not full, porn, but just a little bit of Patrick's Doom. Okay, so the question is the market forgetting about the Fed offloading its balance sheet? Well, there's some people that are arguing that there's actually QE going and the Fed is expanding their balance sheet because of these loans to banks. I don't buy that is actually QE. I think that those are temporary loans, and the QE is or QT is a permanent change in the stuff. There's a lot more, though, unfortunately, going on than just the loans to banks. There's also all of the games that are being played ahead of time with the debt ceiling debate. And my suspicion is, although we have an environment right now where the Fed is engaging in QT, we also have a situation where the TGA, the Treasury General account, is getting run down, and that might be providing liquidity. So the long and short of it is a complicated question with lots of different moving parts, but the Fed is definitely staying on QT, and that seems to be on autopilot. Whether that'll affect markets or not is difficult because of all the different moving parts.
All right. So let's go to the second question. Another long one that's just a head-spinning long economic question. So this one's completely for you, Kevin. Let me see if I can nail this one here. So, hey, you degenerates. I love listening to the show, and it's my first time writing in with a question. Powell has some comments yesterday about raising rates and got some questions from Warren about rising unemployment, which went on to make the rounds on the Bird app, I guess, Twitter.
That's what the cool kids call it.
They call it the Bird app. I like it. So do you think central banks believe that inflation is not a problem until it gets into wages, and then and for them to successfully combat inflation, they accept that they need to see unemployment rise? And if so, do you think it's possible for labor to increase its share of GDP, or is this something central banks are likely to fight? And are we destined for a continuation of sideways or declining labor share of GDP?
Sure, that's a great question.
That first, or should I just,
I love that question. Do I think central banks believe that inflation is not a problem until it gets into wages? No, but I do think that because I think that they also think inflation's a problem when oil's taken off and there's a million other parts of it. But do I believe that they are concerned about the wage inflation? Yes. And Powell talks a good game about not wanting to put people out of work, but in his heart of hearts, I think that they believe that to slow inflation, they need to cause pain in the economy and therefore put people out of work. So if they didn't,
they can't say it,
but I think if they didn't, they wouldn't look at the Phillips curve. They wouldn't talk about these things. They wouldn't care about employment. Yeah. So do I think, one second, right. Do I think it's possible for labor to increase its share of GDP, or is this something that central banks are likely to fight? So I think that labor is possible to increase its share of GDP, but I also think at the same time that central banks will continue to fight it. And so therefore, are we destined for continuation of sideways or declining share of GDP? No, I think that labor's share of GDP is going to continue to go up, and that the central banks will both continue to fight it. And therefore, we will see a situation where labor is doing better than Wall Street, like Main Street winning over Wall Street. And it will be precisely because of that.
Right. So the listener went on to comment saying, I would think that that if labor were to see its share of GDP rise, that it would translate into some combination of wage inflation and or compressing profit margins. Both of those don't seem like data points welcomed by central banks. I know the Fed has a dual mandate now, but my impression is that tackling inflation is objective 1A. And the one thing I'll comment there, it's interesting they call it dual mandate, but I very few people talk about the third mandate, which I would almost argue is more important than 1A, which is
so I'll push back
stability.
on that because I think that this was an example of them. This latest Powell presser was an example of them saying inflation is by far and away our most important thing. And for all you folks that think that there's a put because we're having some bank crisis, that put is struck way lower. And I think that was the message.
I know, but that's where I push back and you back again, which is basically I don't think that this is a financial crisis yet. Wait till actually money center banks are in problems, and then you'll see whether they want stability.
But Patrick, all we're arguing about is the strike, and then we call it a strike. But the reality is, you could call it about the strike in terms of how much it affects the financial system.
I personally think that a couple of regional banks going under, if they can keep the big money center banks going, is not going to be.
Just one last little tidbit. I saw that Chanos emailed or tweeted something out saying, we had in the 80s lots of banks going under, and we still managed growth. This is the American system is designed to have competition in banks, and it's almost like a feature, not a bug, of them going under every now and then. So I know that that seems kind of crazy to say, but it's the way their system is set up. Anyways, go on to the last little bit.
So, and the second question was simply, when are we going to get Jimmy Jude back on? I need a good laugh, thanks. Because we're not funny.
Well, Jimmy is way funnier than us.
Like he is really funny, and he does have an open
whenever Jimmy wants to come on,
I hope
we'll get rid of talking charts and all the things, and we'll make room for him. All right, what's our third question?
We've got to prioritize here. All right, so the third one is, if you were to go on Twitter and use the WTI futures term structure to predict the forward spot price, you'll be mocked mercilessly. And Jeremy McRae tweeted an excellent animated chart that showed how poorly the curve has done for predicting future spot. But all the Twitter Illuminati are happy to look at various interest rate future curves and divine future interest rates. Why is it okay for rates but not oil? Sometimes it would be a cooch with market expectation, but really,
you want to talk about it?
All I want to say is that to me, when I look at, let's say, a term structure on oil, I look at it as the curve just adjusting for carry, interest rates, storage, seasonality, all these types of things. But that's adjusting to its relative price and not necessarily forecasting where it actually be.
No, you're absolutely correct. It's a function of carry and things like. But the thing about, I guess, the interest rates that's different is that the interest rates is more easily arbitrageable. And so it's expected to be that is like when you go and look at the Fed funds future, let's just use that as an example. It is not just something that is affected by carry. That is literally a contract that will expire into what the Fed funds at the time. And I guess you could say the same thing about oil, but I'm trying to think of why you would argue that it's different. I guess that the difference is that there's different users using the oil futures market, and it's not. You know what?
It's strange for me because I've never actually thought of it that way. Because when I look at the term structure, I look whether the curve is in backwardation or whether there's a contango or how steep that is. But I've never once, in my mind, connected the dot that because the December 2024 contract is there, that's where it's going to be. I've never kind of used it to think of it that way.
Because you could at the same time. What I'm trying to think about and think through is that if you did the same exercise where you showed the future interest rate curve that the market had priced in and then looked at where it actually went, you'd realize that that curve can be just as wrong, and often is just as wrong as the oil curve is. So what I'm trying to, square in my mind is, why is it that you get mocked so badly for saying that the futures curve is here in if the market's saying that oil is going to be here in a year, but then the market's saying that the interest rate's going to be here in a year. They both have the chance to be really, really wrong. And then you might say, well, but one, you could go actually transact and do hedges there, but it's the same with oil. And so I don't really have a good reason why it's so much worse than on, for WTI, because it's on interest rates. The curve is often just as wrong. Why don't I'm sure there's going to be somebody that's a lot smarter than both Patrick and myself that's going to know the answer to this. Tweet it out and let us know why it is that that those two are not the same, because I think it's a great question.
All right, so just quickly, if anyone's got questions for either Kevin or myself, you can submit them to nostupidquestions@markethuddle.com. But I do want to just highlight one thing on this, Kev. I think after just having had the opportunity to do Lena's job and read these questions, I'd like to make a suggestion to listeners. I'm going to, when screening from now on, give a few extra bonus points to anyone that can keep it under 100 words. Keep it down to one question, unless there's with side effects or really nice compliments for us. But it really these kind of tier. We would appreciate it if the questions,
because Patrick and I aren't very smart, so it's got to be simpler.
So, nor very. Nor do I know
actually,
how to
I think you did a fabulous job.
So
all right.
Makes it easy.
So thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on Twitter at the Market Huddle. Give Lena a shout out. She gets tired of talking to Patrick and myself and I. You can listen to the Market Huddle at all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe. Patrick, where can they find you?
You can find me at bigpicturetrading.com, or you can follow me on Twitter at Patrick Ceresna.
They can go check me out at at themacrotourist.com, and you can actually go and chat with me on Substack now. They have a chat, and so you can go get the app. And the interesting thing about it, and the great development, is they finally have a desktop app, so you don't need to do it on your phone. You can actually do it on your computer. We have a great group that are there chatting all the time, so go check it out and give us a holler.
And on behalf of Kevin, I would like to highlight that he prefers questions to be less than 100 words long and would kept to one question per message, right?
All right. So listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. Now stick around for a quick little after hours. Okay, so Patrick.
So I got to rate this beer.
You got to rate this beer, and then I got something to do after. I just remember that I want to do.
I want to highlight as well, but okay. But I was going to say Sky Bison. I was like, they make a comment. Great beer for every occasion. I was like, well, that's a cheesy comment, but you know what? It is actually a nice, crisp drinking beer. I liked it a lot, actually. 8.1.
Well, I'm going to go try to.
I would recommend.
I'm going to try to track down my kids, see what they thought.
No problem. Okay. But listen, I had a great, what's it called? The other Friday, I had a great St. Patty's Day, buddy.
Oh, what happened?
Like I went and had one of those, not one. I had multiple of those liter green beers that they serve you at the Irish pubs, and watching a nice live concert. It was
Where was this? Where were you?
I was in Playa.
Oh, okay.
In De Carmen, down in Mexico. But it's a
lots
great
of Irish
party. But tons, actually, surprisingly, it's a vacation spot.
Everybody's Irish.
Irish are everywhere.
Everybody's Irish on St. Patty's Day. Everyone's they got like 5% Irish, and all of a sudden they're talking with an accent.
What's your story, buddy?
Okay, so I have something to highlight for you, and I'm actually a little worried about this, and I want you to promise me that you won't take any legal action against this person.
Yikes.
Okay. But I was someone was talking about a book on that Bird app, and I was like, oh, what's this book? And I saw a couple of people that I respect and liked it and talked about it, so I was like, oh, I'll go have a look at it. And it's called The Reset. And I just want to read to you, and I'm going to do this in my best Hollywood voice. I'm going to read you the little snippet about what it's about, Patrick, because here we go. The reset is coming. The reset is the day when hyperinflation slams onto U.S. shores. Paper money becomes worthless. Food and water are scarce. Stock markets go to zero, and the current economic system burns to the ground.
Doom at 11 o'clock.
That's right. The vacuum will be filled at first by chaos. This novel is the story of the weeks, days, and hours leading up to the reset. It is an accelerated tale of broken love, paper money, and recreational self-destruction in the final days of the last American bubble. This is a story of how trees do not grow to the sky. Now, so I just want to know how many hours of that other podcast that you cheat on me with did this writer listen to before writing this?
Well, I mean, it's easy. All he has to do is take the transcripts from the last 2 years and simply put it into a book format.
That's right. So listen, I want people to chime in and tell me if this book is actually good, because these two people that recommended it, I respect them both tremendously, and they're not the most doomish guys. So maybe it's a great novel. Maybe this is a lot of fun.
Novel. That's a novel.
It is a novel. It's not a prediction. It's fiction. I believe it's fiction.
Oh.
I'm hoping it's fiction.
I hope so too.
It's Jack Moore, The Reset. If anyone has read it, I'd love a book review. Actually, that would be great. I'd love an actual book review of The Reset.
Awesome.
All right.
We kept it nice and tight. I mean, I think the show might come under 3 hours.
That's right. It's going to be a long one. So we'll let you go. Pauline has got a lot of editing to do.
All right.
Have a great week, everyone, or actually a couple of weeks. See you then.
Thanks, everyone.